Okay, good morning. Right. So I think you can hear me, right?
Yes, sir, we can hear. We can hear.
Right. Okay. Uh, s- so today, our aim is to discuss the areas relating to corporate finance part, right? So therefore, we already you had initial session to discuss the key requirement of this case study, and so I'm not going to discuss anything related to that, and therefore directly we'll focus on this area, right? Because here, under the integrated case study model, right? So this corporate finance and risk management part, so that include around 20%, right, of this particular assessment. So therefore, it's a fairly considerable and important part. And I think you all, this is fairly easy part also, right? As the chartered accountants in few days, right? And so since you have completed all the exams, right? So I mean all the modules relating to this uh, program, right? So therefore, this part fairly easy, right? Because I know, especially for the chartered accountants, this finance part, that's a fairly easy part, and all are very good in this quantitative part. Uh, but so according to the requirement of this module, right? And so we'll discuss what are the key points that you have covered under this corporate finance and risk management area, right? So within this uh, time allocated for the corporate finance and risk management part, so we'll revise. So the key points included in this uh, uh, corporate finance and risk management part, and certain points really included in this study text. Some questions also we'll discuss, and but so here I mainly focused on discussing the key principles and the fundamental calculations, because as I mentioned, so you all very good in these concepts, right, relating to corporate finance, because that is one core area to be a chartered accountant, and so you all good in analyzing these points, right? But we'll start with the initial points that you have discussed in this module, right? And but one limitation when we do this session as an online session, that the interaction there is uh, I mean limitation, right? But I hope so you all will uh, participate, right? So you participate uh, actively. So here you have the access to send chat messages, but I think it's not possible for you to ask questions and answer questions right verbally, right? So that option is not there, as no so but here, rather than listening to a lecture very passively, I hope so you will answer the questions, at least through these chat messages, and I hope you ask questions that you have relating to any of these issues, right? So I'm Sanjeev Gurge, and currently I'm attached to the Financial Intelligence Unit of the Central Bank of Sri Lanka, and so I got my membership in this institute long time back in 2003, right? So it's 22 years ago, right? Can't imagine such a long period. And so I hope you ask questions, right, relating to this. And so we'll have a effective and important session here. So please, raise your, questions whenever you need any clarification. Right. So we'll start with the basic points which you have learned throughout this program, because corporate finance, as I mentioned, that's a very, very important part, because that include various important finance decisions that all the organizations need to make. Because we know when we are learning accounts and finance, we learn there are different forms of business organization, but whatever the form of the business organization, we know they all need to make finance decisions. So that's why corporate finance is important. All the organization, not only the organization operate with profit motive, but even the organization operate without profit motive. They also need to make finance decisions, right? They also need to make finance decisions. So therefore, this corporate finance, right? Because we learned in accounts, right? Organization operate without profit motive, right? So we have done accounts relating to non-profit organizations, clubs and societies and various other organizations that operate to give, with the objective of giving the benefit to their members, right? But still they need to make finance decisions. So therefore, finance, right? Corporate finance, that's a very important requirement, right? Important part for any organization, right? So all the organization need to make finance decisions, right? So therefore, we need to know the objective of this corporate finance, right? The objective of corporate finance. And we know whatever the form of the business organization, as I mentioned earlier, right? So at the very beginning of this program, you have learned there are different forms of business organization: sole proprietorship, partnership, and companies, and various other organization with different expectation, but they all need to make finance decisions, right? But objective, once the business starts, the objective is to increase the value, right? So here in finance, generally we use the term, the objective is increasing shareholders' wealth, right? The maximization of shareholders' wealth. But even if we use the term shareholders, since we mainly focus on company, right? So that objective has been developed based on the condition that, so considering the fact that the mainly considering companies, right? Because you all know shareholders means, right, in a company, shareholders means what, right? Shareholders are the right. So you can give your answers in this chat box, since that is the only option here, right? So you can do that. So then we can do this, right? Shareholders are the owners, right? Owners, exactly, right? So owners of the organization, because right, when it comes to a company, so they are providers of capital, but not only providers of capital, but especially they are owners. Because when it comes to the capital, because we know there are two forms of capital, right? So that is also relating to one main finance decision we'll discuss, right? So therefore, they are not only providers of capital, but as most of you mentioned, right, they are the owners of the organization, right? Because they are the providers of particular category of capital, to call it equity, right? So equity, and that's why they are the owners. But there are other types of providers of capital, right? And so one of you have mentioned here E and D, that means equity and debt. So the providers of the debt capital, they are not owners, but they are the lenders to the business, right? So therefore, so this one, I start with very, very fundamental points, right? Sometimes, you might consider this not necessarily too basic, right? But we'll start with that and we'll cover the important points related to corporate finance. So the shareholders, they are the owners, right? And that's why the objective is to maximize the owner's wealth, right? That's the purpose. And in order to do this, because there are number of important finance decisions that all the organizations need to make, right? All the organizations need to make several important finance decisions in order to achieve this main objective of maximization of the owner's wealth, right? And this generally, the generally used term in finance, the maximization of shareholders' wealth, right? Shareholders' wealth maximization. So, in order to achieve this objective, there are several key finance decisions that all the organization need to make, right? So, we know when the organization is trying to achieve this objective, it is necessary to consider, right? It is necessary to, some essential fundamental concepts relating to finance, which you have learned throughout this program, right? The balance between the risk and reward. So you have learned this throughout this program, right? So in various modules, you have learned the important factors relating to these two fundamental concepts, risk and return, right? Risk and return. And so which when we consider the this main objective, so in order to achieve this objective for the organization, so it is necessary to have a balance between these two factors, right? So that the return should be optimized while managing risk, right? So return, so it is necessary to achieve the optimum return. So while minimizing risk, but minimizing means, right? So we know it should be managed, which will vary from person to person, from organization to organization, based on their risk appetite. And so in order to achieve this, some essential points, right? So it's included in this module also. It is important to have diversified investments, and in order to manage risk, various instruments, right? Various strategies used by the organization. We'll discuss that also briefly, right? So within this limited time, what are the main hedging instruments, right? So hedging strategies available for the organizations. And so the main objective, to achieve this main objective, right? Because if you buy shares of a company, right? Because again, if I refer to one main very basic points relating to this, we know in a financial system of any country, there are several key functions, right? Several key functions that that important for any economy, right? Financial system should perform that important function to meet the requirement of the two parties. So that's why I mentioned, for the organization to achieve this objective, right? So they need to offer attractive investment for the others, right? For the individual investors. It may be individuals, maybe corporate, right? So various investors. So they should offer profitable, attractive investment opportunities. So to meet, this is we call in the financial system one main objective, very fundamental point, which you all know from the beginning of this program, channeling of funds. So in a financial system, to meet this main requirement of channeling of funds, you know that there are two main alternatives. There are two main alternatives for the participants. What are these two main alternatives for the participants to meet this main requirement of channeling of funds? Commonly known as what? Right? What are the two alternatives to meet this requirement of debt and equity? That's both. That means those are the two forms of capital. To channeling of funds to meet the main requirement for the two parties. What are the two alternatives for the two parties? What are the two alternative methods? Different answers there, right? So here mainly, what I want to know is not the category of this instrument, because both equity and debt coming under one category, because this is called using some financial instruments, equity and debt, right? Organizations try to meet the requirement. That means the deficit units, right? So various answers there. Still, the answer I expect is not here, right? Because to meet this main requirement of channeling of funds, there are two main requirements, two main alternatives, right? So one thing, using these equity and debt instruments, we call financial assets, financial instruments. These financial instruments should be used in, right? Should be traded in financial markets. So using financial instrument in financial markets, the two parties try to meet this requirement of channeling of funds, and that is called what? That is known as direct finance, right? Direct finance. So both equity instrument and debt instrument, right? So that is coming under direct finance, right? So that is directly the organizations, right? We call the deficit units. It may be organization, it may be government, right? Maybe government. So they use financial instruments, right? And by issuing this financial instrument, they directly meet their capital requirement, right? Fund requirement. So that is one alternative. What is the other alternative? When I say direct finance, you know the other alternative. What is the other alternative? Right? So direct finance means, right, the other alternative is indirect finance. Indirect finance means that is, right, because when we consider direct finance, when the two parties trying to meet their finance requirement directly, right, there is no third party, right? Third party involvement, right? In fact, so we know with the development of these financial markets, to facilitate, there will be some facilitators, but they are not intermediaries, right? So, but indirect finance means what? The two parties meet their requirement through intermediaries, right? So that is not debentures or bonds. Debentures or bonds, that is also coming under direct finance, right? That is also coming under direct finance, because debentures and corporate bond means those are debt instruments, right? Debt instrument. Organizations, right, or the government, they issue this instrument and they meet their financial requirement. That is called direct finance, right? Direct finance. But when we consider this direct finance, one alternative, you know the deficit units. Deficit units, that is government and the organization, they issue financial instruments, right? Yeah. So example for indirect finance. That's very simple, right? Indirect finance means what? Through intermediaries. Intermediaries means, so who are the financial intermediaries? Financial intermediaries. That means the banks, right? Banks and other financial institutions, right? We know in the financial system, there are various types of financial institutions, right? Various financial institutions. Some institutions are called deposit taking institution, so non-deposit taking institution. So these financial institutions, they perform the important role of, right, this channeling of funds. So what is their intermediary function? What is their main role? They collect deposits from various parties, right, and they convert these deposits to loans, right? So they perform the important role of this channeling of funds, right, through their intermediary function, right? So here, okay, one question is that about primary market and secondary market. That is another criteria for the classification of financial market, right? So that is only coming under direct finance. So in direct finance, the prime, okay, I will mention the meaning of this primary market and secondary market. That is one way of classifying financial market. Only one component, right? So when we analyze the financial system helps to perform this important function of channeling of funds using two alternatives. What are the two alternatives? Direct finance and indirect finance. Direct means through directly using financial instrument in financial markets. So here primary market and secondary market means that is one way of classifying financial market, right? I will explain the meaning of that, right? Okay, so these two main alternatives, direct finance, indirect finance. Direct finance means using financial instrument in financial market, but indirect finance means through financial intermediaries. If company take a loan, then it is coming under indirect finance. That's correct, right? Because here for a company to meet the financial requirement, they can use two methods. They can either issue financial instrument. It may be shares, right, like equity, or it may be debt instrument, debentures. In Sri Lanka, we know there are no corporate bonds, right? But in various other countries, the organization can issue corporate bonds also, right? But we know in Sri Lanka, only the government issue bonds, treasury bonds. But we know the organization can issue debentures and other debt instrument. So that is actually coming under direct finance. The other alternative is through financial intermediary, right? So the question, the question you have asked, that's correct. So if a company take a bank loan, that is indirect finance, right? Because that is, then what happens? The banks, right, other financial institution, they collect deposits, right? They collect deposits and they provide loans. That is their main function, important function for a particular country, particular economy. So financial market, which is one important component in direct finance, right? Under the direct finance, one important component, financial market can be classified based on number of criteria. So that's what, this one question one of you asked earlier, primary market and secondary market. That is one method of classifying financial markets, right? What is the meaning of primary market and secondary market? That depends on the nature of the instruments, right? Financial market means definitely that is the market where financial instruments are traded, right? You know the meaning of market. You learn economics and various other subjects related to this. And you know market is a place where a particular product is traded, right? So the buyers and sellers, they, do the trading for a particular asset. So financial market, so that is the place where financial assets are traded. So one method of classifying financial market is called primary market and secondary market. So primary market is the market where the new instruments are traded. New, right? Totally new instruments are traded. That means when the issuers, when particular organization or the government, when they issue a particular instrument for the first time, that is called primary market, right? So, organization, they make new share issues. We call initial public offerings, right? And that is primary market. And government issue these government securities, right? Government securities. And so it was an agency function of the central bank until December, right? And after December, that function was now it was removed from the central bank. Now it is under the Ministry of Finance, right? The public debt management. So that there, the central bank issued government securities, treasury bills and bonds. And when there is a new auction for a treasury bill or a treasury bond, that is primary market, right? And then those who purchase these, instrument from the primary market, they will do the trading in the secondary market. So secondary market is the place where already issued securities are traded, right? So that is one method of classifying financial market, right? Only one method of classifying financial market. So that is not similar to direct finance and indirect finance, right? There are other ways the financial markets can be classified, other criteria, right? What are the other criteria? Financial markets can be classified based on the maturity of the instruments. Based on the maturity of the instruments traded, the financial markets can be classified into two categories, right? Whether the short-term securities are traded, the long-term securities are traded. That's correct. So one of you mentioned the classification, money market and capital market. So that is another way of classifying financial market. The criteria is the maturity of the instruments traded. Based on the maturity of the instruments traded, we classify the financial market as money market and capital market. Money market is the place where the short-term instruments are traded, like treasury bills and money market instruments, right? The commercial papers, so like that. So short-term instruments are traded. But capital market, that is the market, right? In fact, I didn't change the slide yet, right? Because here some main point I discussed yet, right? So we'll move to the key functions, right? Because this is initial point relating to this entire part. So that's why So you know that money market and capital market. So that is another criteria, right? That is another criteria of classifying financial market, money market and capital market. And based on the organization of the market, it can be classified whether there is a third party to facilitate transaction or whether there are there is no third party. Directly, the two parties do the transaction. Exactly, right? So this is the classification. Over the counter market and exchange traded market, right? Over the counter market and exchange traded market. So if there is no third party and the two parties directly do the transaction, it's called over the counter market, OTC market. The other, if there is a third party to facilitate, that is called exchange traded market or exchange regulated market, right? So that is another classification. Based on the timing of the instruments, so timing of the transaction, the financial markets can be classified. Whether the transaction take place immediately or whether the transaction take place at some future date, right? In the future. And based on that also financial market can be classified. And that is called, if the transaction take place immediately, spot market. And if the transaction take place at some future date, then it is called, a commonly used term is forward market. Okay, that's correct. But forward, that is only one type of, these future transactions. Therefore, the proper term would be derivatives, right? So derivatives, because forward, futures, options, swaps, there are various types of, instruments or the contracts that two parties can use to do a transaction in the future. So, but this is correct because it is very commonly used, the term forward market, right? Spot market and forward market. Whether you get ownership or whether, that means due to that particular financial instrument, whether you become an owner or a lender. So based on that also we can classify equity market, debt market, various criteria, right? Since, so one of you asked about this primary market and secondary market, I mentioned this, right? And there may be some other criteria, right? So based on various other criteria, this can be classified. And based on the trade intermediation, it can be classified, right? So dealer-driven market, code-driven market, right? So it can be classified based on number of criteria, right? So out of these two alternatives, direct finance and indirect finance, especially in developing countries like our country, what is the more commonly used or more famous alternative? Is it direct finance or indirect finance? Right? Right? Indirect finance. So more famous, right? More famous or most commonly used method is indirect finance, right? Indirect finance. And why? What are the reasons for that? Why? What are the main reasons? So your answer is correct. Easy, cost is less, right? Easy access, large spread, private firms, easy to obtain. Okay, so these are valid points. But the main thing is what? Okay, so here, okay, one very relevant point is there. You have used the term financial literacy. Good, right? So that's one good point. So one thing is financial literacy, because to use direct finance, it is necessary to have some understanding. When you are going to trade in financial instrument, there should be some finance knowledge, right? Financial literacy should be there, right? Financial literacy should be there. But so that is one main factor. That is one main. Okay, another thing, as you mentioned, risk. Risk is another factor, because when you are going to give your money, right, as a surplus savings, we mainly consider risk, as I mentioned at the beginning also, because whenever we make this investment decision, right, so risk is one main factor we have to consider. right? So therefore, that is another point, because as far as risk is concerned, many parties would consider, right, indirect finance is less risky, because you deposit your money with a good, right, as long as you are confident about the financial institution, you don't need to worry, right? So based on the level of risk you are willing to take, right? So based on the risk you are willing to take, the institution also you may consider, right? You may consider, and based on that, you make the deposit. There is no any other burden. You wait until the deposit matures, you get the agreed interest. No, risk is relatively low. But when you invest in financial instrument, we know the value of the financial instruments will change, right? That will change. So due to various factors, based on the nature of the instrument. So therefore, it is necessary to take that risk, because unlike the investing in making a deposit in a financial institution, making investment in financial instrument is more risky. That is another factor. So two main valid points given, right? So you mentioned financial literacy, risk, but that is another very important point. Even if you financial literacy is there, why it is not right? Why many parties, right? Why many parties not using financial instrument? Regulation, right? More than the regulation, right? Okay, regulation. You mean maybe you consider not strict, right? The main point is the financial markets are not efficient, right? So financial markets are not efficient. So that's the main reason, right? Financial markets not efficient. Efficient means what? Especially in developing countries. What is the meaning of efficient financial market? Market efficiency means what? Market efficiency means what? One main thing is, okay, so one main factor you have mentioned, informational asymmetry, right? So, and due to that, right, always there is a possibility, right, that the financial assets are mispriced, right? The information are not fairly equally available to everyone, and that's why many parties not willing to use this. The financial markets are not efficient, the assets are not priced properly, and so these key points related to this entire part, corporate finance, some key points I mentioned. So that's why still in the first slide, right, I didn't move that, right, because here before we move into specific areas, so these points are important, and that's why the key important points I mentioned at the beginning, right, so that we can move to right, the key points, right? Okay, so these are the main things, right? So here the main reason the many parties not willing to use direct finance, right? The financial markets are not efficient, and therefore, right, that is relating to the other valid points you mentioned. Risk is also there, but even if those who have the financial literacy not willing to use this method, especially in this in a financial market like our market, because it's not possible to use these valuation models, and it's not possible to make above average gains, since the due to this market inefficiency, manipulations there, a lot of manipulations there. So therefore many parties not willing to do that, right? So therefore, when we are considering these objectives, right, objective of corporate finance, so these factors should be considered with respect to these main fundamental concepts relating to this finance, right? And when you are going to invest in a company, right, especially in the shares of a company, you expect two types of returns, right? In fact, not only shares, whenever you invest in financial assets, financial instrument, you expect two types of returns. What are the two types of returns you expect? Okay, so with specific to shares, you can say dividends and capital gain, right? And if it is a debt instrument, interest and capital gain, right? So that means we expect periodical return. periodical return, regular return. For shares, it is a dividend. For debt instrument, that is interest. And the other thing is, right, the other main gain is the capital gain, right? So capital gain. So when, therefore, these finance decisions, so now we mainly focus on this main objective of shareholders' wealth maximization. So the two returns, as you correctly mentioned, dividend and capital gain. So all the decisions taken by the organization should lead to achieve this main objective, to provide the maximum return to the owners, right? So highest dividend yield and capital gain yield. So those are the expectation. So in order to meet this requirement, all the organization need to make several important finance decisions, right? What is the most important finance decision, right? So this is directly related to corporate finance. What is the first and important decision that organization should make? What do you call it? Investment decision. That's correct, right? Investing decision, right? Investing decision. So which is also called capital budgeting decision, right? Because okay, so here, so one of you mentioned all the decisions. I mentioned the main first one, right? The first decision. So it is investment decision, right? Which is also called capital budgeting decision, right? Capital budgeting decision. That is, organization need to identify the profitable in long-term investment, right? Long-term investment. Once the long-term investment is identified, and then it is possible to, right? Then it is necessary to make, right? You already mentioned financing decision, right? Once you identify the proper investment, then it is necessary to decide how to finance it. And once the organization finance, and what is the next decision, right? So you can say dividend decision, but sometimes it is argued dividend is a part of financing decision, right? Because we will discuss this. It's okay, right? That's correct. That's correct. So the organization should identify the correct investment. It should be financed using the best combination of the combination of capital. Yes, right. So here the other important addition is given, right? So one of you mentioned working capital addition, working capital, right? So it would be proper classification. The project should be identified, should be financed, and it should be continuously managed, right? So dividend, without a doubt, very important decision, which is directly relating to the main objective of maximization of shareholders' wealth, right? But it's actually part of financing decision, because the meaning of dividend. Once the organization generate profit for the organization, then it is necessary to decide whether to distribute the profit or to retain, or what is the all these the study materials, not only this PPT, right? So PowerPoint, I have used, I have prepared one Excel sheet to discuss the key points relating to this area, corporate finance part. Everything will be shared, with you, right? So I will share with Mr. Aruna, and so he will share with you all, right? So this all the materials I used here will be shared with you. So the investment should be identified. The investment should be identified. It should be financed, and it should be continuously managed. Dividend, so important. There are many factors the organization should consider. The dividend policy, dividend decision should be taken correctly in order to maximize the shareholders' wealth, to achieve the main objective of finance. So the main objectives, right? The main finance decisions. What long-term investment should you make? Where will you get the long-term financing, and how will you manage your everyday financing activities? And that's what you call capital budgeting, which means the investment decision, the capital structure, financing decision, and the working capital management. So that is the short-term financial management, right? So these terms are also used for this investment, financing, and short-term financial management. The reason to use capital structure, no need to explain you. The way of financing the investments of the company will decide the capital structure. Whether to finance using equity sources or the debt sources, or what is the best combination, that will decide the capital structure. So therefore, these decisions should be taken properly. And you all know, right? Actually, this corporate finance, that's mainly relating to these main decisions, right? Main decisions. All the decision relating to, all the analysis, all the factors relating to these these key decisions that is coming under corporate finance. And when an organization is going to make investment decision, which is probably the most important thing, right? Because we know, right? So you all know very well, if the investment decision is not taken properly, whatever the accuracy of the financing decision and the subsequent decisions, the organization will not be able to achieve this main objective of maximization of shareholders' wealth. So that's why the investment decision should be taken with detailed evaluation, the proper evaluation. And that's why there are a number of principles that should be followed in making the investment decision. Investment decision, as you all know, the organization should analyze the available long-term investment. Because this wealth maximization is a long-term decision, right? Wealth maximization is a long-term decision, right? And in order to make this long-term decision, right? Long-term objective. In order to achieve this long-term objective, there should be long-term investments, right? Long-term investments. And when an organization considering to accept, right, to decide whether to accept or reject a long-term investment, detailed evaluation should be done. This analysis entirely based on what? Right? This capital investment decision, that is entirely based on what? No, I mean this analysis, right? Because this is a decision that the organization is going to. Okay, that exercise is called projection. That is what I expected. That means that exercise we call project appraisal, and for that we need the cost of capital. But that analysis entirely based on projections, right? Estimates, assumptions, right? So therefore, the accuracy of this decision depends on the accuracy of these projections, right? So this the capital budgeting decision, the capital investment decision, entirely based on projections, estimates, assumptions, right? So therefore, there are a number of principles that should be. It also requires risk assessment. Risk assessment is, right, very, very important, right? That's what also we are going to analyze, discuss here. Because once we do the basic analysis, right, based on these predictions, right, projections, that doesn't mean the organization will definitely achieve that return. That is not the meaning, right? Because it is entirely based on projections. So therefore, it is necessary to analyze the risk. And that's why you have very correctly mentioned here, risk assessment is simple. So there are techniques, right? So there are various analyses used to analyze the risk. Used to analyze the risk. Okay, so therefore, we should consider, right? We should consider these principles and other risk assessment before making the final decision, right? Before making the final decision, right? So, what are the main principles? Because this, as you also correctly mentioned, this analysis is entirely based on predictions, projections, assumptions, estimates. That means when we estimate, what is the first step? We need to estimate, because when you are going to evaluate a project, we have to estimate the return. Exactly. Okay, so you already mentioned the first step is the estimation of cash flows. Because so we know when we are analyzing a project, right? When we are analyzing a project, the project appraisal, as one of you already mentioned, can be done using different measures, cash flows or profit. But what is the better measure? As you already mentioned, cash flows. Because we know to evaluate a capital investment, profit is not the ideal measure, right? So the better measure is the cash flows, right? Cash flows, right? NPV, NPV is a technique. NPV is one technique, right? NPV is only one technique, model used to take that decision, right, to evaluate. But analysis should be based on cash flows. That is one important thing, right? So therefore, the first step in the capital investment decision is the estimation of the cash flows. When we are going to estimate, timing is important. Timing is important, right? So that's why I mentioned earlier, the accuracy of this decision entirely depends on the accuracy of our estimates. All these factors. What is the appropriate time for the project? And for that particular period, we have to estimate the cash flows. When we are going to estimate the cash flows, there are a number of important principles that should be followed. When we are going to evaluate a capital investment, right? Because when we estimate the cash flows, right? Once we estimate the cash flows, then we can evaluate the project. To evaluate the project, we can use number of techniques. One technique you already mentioned, right? What are the other techniques, right? You mentioned one technique. NPV is one technique. Okay, another technique, ARR, IRR, payback. Okay, those, right? Those techniques I don't need to talk about, right? So you all know very well, right? So how to do this, how to calculate these values, right? So you mentioned all the key project evaluation techniques, right? ARR, which is a very simple accounting based technique, right? Accounting rate of return, which is also called average rate of return, right? And then payback period, another simple technique, then NPV and IRR. Okay, so these techniques, these are the techniques used to evaluate. So when we are going to evaluate a capital investment using these techniques, the accuracy depends on the estimation of the cash flows. So that's why when you are going to estimate the cash flows, number of principles that should be followed. When we estimate the cash flows, we should, right, once we estimate the cash flows, for the evaluation of the project, we should consider only relevant cash flows, right? Okay, here, right, so you all already mentioned, right, also mentioned about APV, right? So APV. So here, this mainly, right? So, right. So what do you mean by APV? Because this is there are different ways this can be interpreted. So here you mentioned annual, percentage value, or right, adjusted present value. Okay, adjusted present value, because sometimes when there are, especially when you are going to rank the projects, right? Rank the projects with different time periods, right? There are techniques like that, right? There are some more techniques to do the comparison, especially when the timing different. So that also you can consider, right? So this okay, so we'll see what are these different techniques and how to make do these calculations, right? I'm sure you all familiar, but just to revise without spending too much time. So I have used some simple examples for you to see what are the different techniques. Not only when you are answering the exam papers, certain methods you used, right? But when you are doing the real analysis in your organization, right? So maybe most of you still maybe you do your practical training in audit firms, so some of you may be already working in organization. So then especially when you are doing the actual analysis, right? So what are the other alternative methods that you can use? So that also we'll discuss, right, here using some examples, right? So let's try to do that. And so here these different techniques, right? These different techniques used to evaluate the project. And another point, mostly checking these case studies. So when there are several projects, several acceptable projects, right? When there are a number of acceptable projects, but all the projects are, it's not possible to accept all the projects due to the capital constraints. And then we call it, right? What is that condition? That is called capital. Okay, that situation is called capital rationing. That's correct. So here, some of you already mentioned what are the techniques that can be used in capital rationing situation. That condition is called capital rationing. Capital rationing. In capital rationing situation, we have to rank the projects, right? So we have to rank the projects in order to select the best project. So in capital rationing situation, in order to rank the projects, what are the different techniques available? PI, okay, profitability index, and NPV. Okay, NPV, is it a good method to rank the projects? NPV? NPV is not a good technique to rank the projects. Even in this integrated case study that this study text, I saw that they have used, but it is not correct, right? It is not correct. So NPV we can't use as it is to rank the projects, right? So here, especially now we'll say this sensitivity analysis that is not used to rank the projects. Sensitivity analysis is used to analyze the risk of the project, right? So one of you mentioned earlier risk assessment, right? And for that we use sensitivity analysis, right? Sensitivity analysis is not used to rank the projects, but that is to analyze the risk of the project, right? And especially when we have projects like this, right? Projects like this, so different projects, and when there's a capital rationing situation, right? So when there's a capital rationing situation, when there is a when there's a capital rationing situation, and when there are projects with different investment requirement, initial investment requirement, is it correct to rank the projects using NPV? Is it correct? That is not correct. That is not correct, right? So that's why NPV concept we can use. Using NPV concept, you have to calculate what? Profitability index. So that's why most of you have already mentioned here, right? Already mentioned here profitability index. Profitability index is based on NPV concept, and that's why in some finance books for this profitability index they use the term present value index, right? Present value index. So therefore, NPV as it is, we should not use to rank the projects, right? I saw that mistake even in the answer in this study text, which is not very correct. Which is not very correct, right? So the better techniques are IRR. Yes, definitely. IRR can be directly used because IRR is a very useful technique, right? And not only in project appraisal, IRR concept is used in many places, right? In many finance decisions. In bond analysis, we use IRR, right? What is the term you use for the IRR of a bond? IRR of a bond is called what? What do you call it? No, it's not value. It's not coupon. It's yield to maturity. Exactly. It is yield to maturity, right? So IRR of the bond means yield to maturity. Yield to maturity, right? So yield to maturity. And IRR we also used in analyzing cost of capital. So you can see IRR is a very useful technique, right? That's a very useful technique. Not only to evaluate the project, but even to rank the projects in capital rationing situation. When we are evaluating, analyzing bonds, when we are analyzing cost of capital, at various places, we use IRR concept. So that's why it's very useful, right? Okay, so we need to make this investment decision with detailed evaluation, right? Detailed evaluation. So the first step in the investment decision is estimation of the cash flows. And when we are going to estimate the cash flows, there are a number of principles that should be followed. When we are estimating cash flows, when you are going to evaluate the project, out of the estimated cash flows, we should use only the relevant cash flows. We can use only the relevant cash flows. What are the relevant cash flows? What is the meaning of relevant cash flows? Right? Cash flow will be relevant only if it is exactly. This is the exact term, right? One of you mentioned the exact term, right? It's not operating cash flow. The exact term is incremental. That is the perfectly correct term, right? So that is the perfectly correct term, the perfectly correct principle when we are going to evaluate a project. This is so important when you are analyzing your case study, right? This is a so important concept, right? When you are evaluating a cash flow, whatever the project, because when you have to evaluate a project, we can get completely different types of information, right? For different projects, complete different information can be given. So that's why your financial management paper, the module in this program. So you may have analyzed various types of projects, right? So that's a very important part of corporate finance also. It's not possible to practice 2-3 questions and answer that particular question, right? So many different types of projects, different types of information. But this, as long as you are very clear about this concept, right? As one of you mentioned very clearly, the main principle is the cash flow should be incremental, right? So that is the key principle, incremental. Incremental means what? Incremental means what? Due to the acceptance of the project, there should be a change. That is the main meaning, right? Incremental cash flow means what? A particular cash flow will be incremental to evaluate a project, right? Only if that cash flow is changed due to the acceptance of the project. Therefore, right, commonly there is another term commonly used for this incremental cash flows, right? What is the other term, right? Anyone remember? What is the other term used for this incremental cash flows? Yeah, definitely it is relevant. I mean, okay, not necessarily additional. It may be other way also, right? Changing, okay. It's called differential cash flow. Differential cash flow, right? So changing, you can consider, right? But it's not additional, because differential means what? Because due to the acceptance of the project, certain cash flows may be reduced, right? I mean, if the cash outflow is reduced, that is relevant. That is incremental. Therefore, this is not only additional, but incremental means differential. Differential, right? Differential cash flows. So that is the main principle, right? That is the main principle. When you are going to evaluate the project, when you are analyzing the cash flows, what are the cash flows that should be used? You should use incremental cash flows, which means differential cash flows. So therefore, whenever you get the information relating to a particular project, you need to see, due to the acceptance of the project, is there a change? Only if there is a change, that cash flow is relevant. Because there are some cash flows, there will be a cash outflow also, right? May not be relevant when we are evaluating a project. The reason, whether the project is accepted or not, that cash flow will not be changed, right? Certain cash flows are there. To evaluate the project itself, the organization need to incur. And once the organization incur that cash flow, whether the project is accepted or not, it cannot be changed. And what do you call that type of cash flows? That type of cost, what is the what is the term you use? Certain cash flows, which should be incurred at the beginning. Once you incur that, whether the project is accepted or not, it cannot be changed, right? What is the term? Yeah, it is called sunk cost. Sunk cost. It is not variable cost. It is sunk cost, right? Okay. So one of you mentioned another point, opportunity cost. That is also one relevant point, but not directly relating to this one. But opportunity cost is definitely what? It is a relevant cost. It is a relevant cost. The reason, it is incremental, right? We'll see. That is also one principle. That is also one principle. But the point I asked now, that is, relating to sunk cost. Sunk cost, right? Right. What are the examples for sunk cost for a project? For a project, what are the examples of sunk cost? Research and development. What about legal fees? Legal fees. Well, that we can't always say legal fees is a sunk cost, because sometimes certain legal fees you may have to incur only if the project is accepted, right? So that, depending on the nature, that should be considered. Okay, here some good examples there: feasibility studies, market research. All right, so those are mainly relating to sunk cost. So if there is a sunk cost, that should not be considered, right? That should not be considered, because sunk cost is not incremental. right? Sunk cost is not incremental. Okay, that is another point, relevant point. So once one of you have mentioned, that is also very important point, right? So one of you have mentioned here important point that is called right. So one of you have mentioned. I saw that. So one term was there, right? So a lot of good points. A lot of good answers. Yeah. So one of you have mentioned cannibalizing effect. What is that? That is also another important point when we are analyzing these incremental cash flows, right? That is relating to, that means if a project, when the company accept a new project, if the new project can affect to the existing projects, other existing projects, right? That is called what? Cannibalization is only one side. That is only one side, right? Okay, the meaning someone has explained correctly, right? Very correctly, one of you mentioned a new product or the project reduces sales or profit of an existing product. Exactly, that is the meaning. That is the meaning of cannibalization, right? Of the same company, right? That means if when the company accept a new project, right, and when the company produce a new product, right, that can affect to the existing product. So this cannibalization is only one aspect. That means it affect to the existing products negatively. The meaning you have explained very clearly. When the new product is introduced, the demand or the profit or the return revenue from the existing product can reduce, and that is the meaning of cannibalization. But it can affect positively also, right? So there can be both positive and negative impact. That depends on the nature of the new product, right? That depends on the nature of the product. It's you can say synergy, but one main reason for this one directly relating to the nature of the product. So you all have learned economics, right? So we learned two types of related goods. What are the two types of related goods? Very simple concepts I ask, right? Okay, substitutes, and what is the other category? Related goods, complements, right? So substitutes and complements. The points we mentioned directly relating to these two categories also, right? But for both, both types of cash flows, right? Both positive and negative, we use a single term, common term. If the new product affect to the other existing operations of the company, what do you call it? If the new project or the new product affect to the other products or other projects of the same company, you call it? It is called externalities. Externalities, right? So even we have learned this in the school, right? I remember our school teacher, right? Economics teacher. අපේ ඉස්කෝලේ අපේ මල්ලිකා ටීචර් අපිට කිව්වේ බාහිරතා කියලා. බාහිරතා. Externalities, right? Externalities. So that means it can affect positively, it can affect negatively, right? It can affect positively, it can affect negatively, right? So how it will affect to the new project? Cannibalizing, right? So, okay, how do you adjust that, right? So if there are externalities, how do you adjust that? So that means due to the when the company start the new project, if the new project can affect to the existing products, right? It can affect positively, it can affect negatively, right? Now, as I mentioned, this is mainly relating to this the nature of the product. So there will be positive externalities if the new product is a substitute for the existing product or complementary product for the existing product. Under which condition? There will be positive externalities if the new product is a substitute or a complementary, right? So definitely complementary good, because due to the introduction of the new product, the demand for the existing product also increased. If there is a positive externality, how do you adjust that? The estimated increase in revenue from the existing product should be considered as what? Cash inflow, right? So positive cash flow, right? It should be considered as positive cash flow, right? So, okay, I can, here, in fact, right. So I show some examples because here there were some other not directly relating to this program, but certain questions which I use for some other program. I can show you how to adjust that because for the moment, right. So if there is a positive externality, that should be considered as cash inflow, right? Cash inflow for the new project, right? But if there is a negative externality, right, that is right. The main reason is if the new product is a substitute for the existing products, what will happen? Due to the introduction of the new product, right, there may be decrease in the demand, the revenue from the existing products. And that then what will happen? What will happen? There will be a negative externality. And if there is a negative externality, so what will happen? That should be considered as cash outflow for the existing products, right? 1 second. Okay, it is like this, right? Right now, when you are analyzing a project, evaluating a project, when you are going to calculate, right? When you are going to consider these cash flows, right? So this is how you can adjust that, right? So this will be the revenue and cost of the new product, and in addition to that, if there are incremental revenue from the existing businesses, right? And this is what I mentioned as positive externality. So that should be right. What is the incremental revenue and what is the incremental uh, variable cost? Because if there is an increase in demand for the new product, and due to that the revenue will increase, and then the cost, the variable cost also should be increased. So therefore, the incremental revenue and cost should be adjusted, right? Incremental revenue and cost. So because since so one of you asked how to adjust this, and this is how we do, right? So this is how we can do that. The incremental revenue should be added as a cash inflow. The incremental cost should be deducted, right? And if the net amount is calculated, that can be directly adjusted, right? So it is important. Incremental contribution you can directly use, right? So that's correct, right? So you can directly use the incremental contribution. No problem, right? So that can be done. Right. So right. Well, that the depreciation that is actually one standard adjustment, right? Okay, so we'll see that I will explain that. That's actually a standard normal adjustment, right? Because which is also directly relating to these key principles of project appraisal, right? Because you all know when we are going to evaluate these projects. So when we use this, right? So okay, these are the key principles, right? So these are the main principles. So we should consider only the relevant. Okay, that for that also to be more clear, I will use this Excel sheet which I will share with you, right? So share with you, these are the main principles, right? The main principles of project appraisal. So decision should be based on cash flows, right? Not accounting profits. And this, as we already discussed, relevant cash flows are the incremental cash flows, right? In other words, differential cash flows. And if there is a sunk cost, that should be excluded. And externalities should be included, right? Externalities should be included, right? And the cash flows, okay, and then the other key principles, and I mentioned, one of you already mentioned that concept, that point. When we are going to analyze the project, what we should consider is not only the cash flows that will involve cash movement during this period, right? During this period, not only the actual cash movements, but if you, one of you already mentioned earlier, one important concept, opportunity cost, right? Opportunity cost. That is mainly if the company is going to use its own resources for a new project, right? Already own resources, right? Already own resources. Now, for example, the company has already constructed the building. The building is constructed, right? So everything is done. Due to the acceptance of the project, there is no any change. So the construction cost, not incremental. There is no any change. But if the company is going to start this new project, right, new project in this new in their own building, is there anything relevant that should be considered when we are evaluating? Right? We know, even though there is no additional cost of constructing for the construction of the building, there is what? There is opportunity cost. Opportunity cost. So opportunity cost should be considered. So therefore, when we are evaluating a project, especially when an organization is going to use their own resources to evaluate, for a new project, opportunity cost should be considered. So therefore, the cash flows should be evaluated on opportunity cost basis. So opportunity cost is important. And one of you already mentioned, right? Some of you already mentioned about this timing, which is fundamental concept that we should use in all finance decisions. In all finance decisions that we should use, right? One key concept, right? Especially when a particular finance analysis involve cash flows related to number of periods, right? Number of periods, we know we should use, right? We should consider time value of money, right? So I don't need to tell you about time value of money. That is a concept that you learn throughout this program, time value of money, right? So when we are evaluating, project also, right? For this analysis also, that is important. And you know that you use in many, many topics. When you are analyzing, when you are calculating the price of financial assets, equity valuation, bond valuation, cost of capital, everywhere. So you have used this concept, right? Time value of money. So timing of the cash flows important. So that is right, very important point. And in addition to that, another point, okay, what is PBP, right? So that is payback period, right? So payback period. So you a concept that you all know very well, right? And another concept relating to one of the questions, you asked about this, asked earlier in calculating cash flows. When we are going to use cash flows to evaluate a project, which cash flows we should use? We should use cash flows before tax or the cash flows after tax to evaluate a project. To evaluate the project, we have to use the cash flows after tax, right? Another simple point, right? Another simple point, because we know the purpose. We know the purpose of doing this exercise, that is to see whether this project, right, will increase the value to the business, value to the owners. So we should consider only the cash flows that the organization can retain or can use, available to the organization. But if part of the cash flow should be paid to some other parties, that should be excluded. That's why the tax should be adjusted. And when you are going to adjust tax, and that is the place where you need to adjust this, right? So that's why I mentioned that is relating to one question you asked earlier. depreciation or the capital allowance, right? So the capital allowance, that should be adjusted, right? Because that is to see the tax benefit on the depreciation, right? So therefore, the cash flow should be calculated based on the after-tax basis. So that's why when we calculate the revenue and depreciation should be adjusted, right? So once we deduct the depreciation, the proper term, as you mentioned, capital allowance, right? So once we calculate the tax and then we need to add back depreciation in order to get the after-tax net cash flow, operating cash flow, right? So therefore, that is one important part. So the cash flow should be evaluated on after-tax basis, right? After-tax basis. So that is one very important principle, right? Very important principle. So all the cash flows that we should use for the evaluation of a project should be after-tax cash flows, right? That's why if the company is planning to sell the asset at the end of the capital assets they acquired for the project at the end of the project, we should adjust tax, right? So that we call salvage value, right? Salvage value also, it should be the after-tax salvage value. At the beginning of the project, if the company is going to sell old assets, right? As long as it is incremental, if it is incremental, right? So what should happen? Right. So what should happen? If there is a profit or loss on the sale of the assets, tax should be adjusted, right? Therefore, any cash flow that we should use to evaluate this project, right, should be after-tax cash flows, right? Okay. Then another principle relating to one of the questions also you asked. When we are evaluating cash flows for the purpose of, when we estimate the cash flows for the purpose of evaluating a project, if the company has used certain debt capital to finance the project, a certain part of the project or the entire project. So if the company has planned to use debt capital, we know company has to pay interest. When the company has to pay interest for the debt capital they have used to finance the project. So these interest payments, right? When we calculate this net, after-tax cash flows, after-tax operating cash flows, right? When you calculate after-tax operating cash flows, the interest payment, the finance cost, we should deduct or we should not deduct. To evaluate the project, we should deduct or we should not deduct. We should not deduct. As you very correctly mentioned, we should not deduct. Right? We should not deduct. Why? That is included in what? That is included in the cost of capital. Exactly. Right? That included in the discount rate. Because you know the meaning of discount rate. Right? Discount rate means what? Discount rate means the cost of capital. Right? As you correctly mentioned, weighted average cost of capital. The discount rate is the cost of capital. So cost of capital, which means that include the interest, right? Interest is included in the discount rate. So therefore, when we are going to calculate the cash flows for the purpose of evaluation of a project, capital investment project, finance cost, interest cost should not be deducted because that is included in the discount rate. So if you deduct interest cost and if you discount, that is totally wrong. Right? So that's why, as you very correctly mentioned, right? So very clearly, everyone mentioned the finance cost should not be deducted because it is included in the discount rate, right? It is included in the discount rate. So finance cost should not be deducted. And then another key principle that is due to the effect of inflation, because inflation can affect, inflation can make very significant impact in this capital investment decision, right? Because inflation can affect to the cash flows. Inflation will affect to the cash flows. Inflation will affect to the discount rate. Because as you correctly mentioned, discount rate means the weighted average cost of capital, which depends on the cost of equity and cost of debt, right? When inflation change, the cost of equity change, the cost of debt will change, which means the cost of capital, the discount rate will change, right? So the inflation will affect to the cash flows, The inflation will affect to the discount rate. Therefore, it is very important to treat the inflation consistently, right? Very important key principle in project evaluation, right? In estimation of the cash flows, right? Very important concept, very important principle. Inflation should be treated consistently, which means we have two options, right? So when you are going to adjust the effect of inflation in this analysis, we have two options, right? One option, we can include inflation in both cash flows and discount rate. The other option, we should exclude inflation from both cash flows and interest rate or discount rate, right? So you learn in finance two important concepts relating to these two conditions. The value with inflation and without inflation, which you can use in many analyses, right? Many analyses, you can use that. Yeah. So as you have mentioned here, nominal and real. Nominal and real, right? Real values and nominal values, which you can use in, many concepts, right? Related to the interest rate, nominal interest rate, real interest rate. Related to the exchange rate, nominal interest rate, real exchange rate. And even when you analyze in GDP, nominal GDP, real GDP. Similarly, nominal cash flows, real cash flows, right? So when we estimate the cash flows, we need to be very careful whether we are using nominal cash flows or real cash flows. If we estimate the cash flows with inflation, right, that means we consider this is the price of the product we are going to sell, right? And this is the inflation in this particular country. So the price will increase with inflation, and we are going to estimate the cash flows based on that. Then the cash flows are nominal. We estimate the cash flows with inflation. If the cash flows are nominal, discount rate should be nominal, right? But we have another option. We can consider this is the current price level. We are going to make the estimate based on the current price level. We also call in economics, right? In finance, you call constant prices. That is another term, right? Real cash flows. Constant prices. Real means the price level remain constant, unchanged. And we can estimate the cash flows based on that assumption. The price level remain constant and we estimate the cash flows. When we estimate the cash flows, right, and then in order to discount, what should be the discount rate? Discount rate also should be real. Discount rate also should be real. And so you know the relationship between nominal interest rate and real interest rate. You can easily convert nominal discount rate to real or real discount rate to nominal. For that, what is the formula you normally use? Very famous and commonly used formula. You all know. Fisher's formula, right? So using the Fisher formula, right, you can easily convert nominal rate to real or real rate to nominal, right? Nominal rate to real and real rate to nominal. So that can be done easily. So therefore, it is so important to use this principle. Inflation should be treated consistently. Nominal cash flow should be discounted at nominal required rate of return, because you know this for the discount rate you can interpret in different ways, right? The discount rate you can interpret in different ways. So one method you already mentioned, cost of capital. And the other way, cost of capital, right? What is the other way? Required rate of return. So for the discount rate in the project appraisal questions, you have seen the discount rate using different terms. The required rate of return, cost of capital, right? Right? Okay, so using this, we can do the analysis with the proper understanding. So these key principles, right? These key principles very important. So whatever the project that you have to analyze, as long as you have the clear understanding about these key principles, you can easily do that. Because I know the calculations, that is not a challenge for you, right? So you all are expert in calculations, right? So when you reach this level with completing all the exams, you all so good in calculations. So there is no any doubt. So, right? And the important thing, so we should be very familiar with these principles. But, as long as you understand these key principles, any project you can analyze, right? And so therefore, so it is important. So it is important to have the proper understanding about these key principles, right? So key principles, it is important to have the understanding, right? So right. So when you make the investment decision, you already mentioned, yeah, I mentioned, I share all these Excel sheets and PowerPoint presentation, everything, right? So, so then, here, this, once the, sorry, once this, the capital budgeting decisions is taken, right? So we'll do some analysis relating to this, these concepts, right? We'll do some analysis. So this, when you identify, when you when you analyze this project, when you evaluate the project, right, and identify the correct project, right, based on these the risk and return, right. So we'll see what are these other analysis used to evaluate the risk, right. We'll evaluate the risk with some example. What are the techniques available to analyze this risk, sensitivity analysis and scenario analysis. We'll do that, right. And once this company evaluate the project, right, the next decision is financing. As I mentioned earlier, this financing decision also called the capital structure decision. The reason, the way of financing a project will decide the capital structure of the company, right? That will decide the capital structure of the company, right? The capital structure, whether the company is going to finance using equity or using debt, right? Using equity or debt. There are advantages of using equity. There are advantages of using debt, right? And you know mainly what are the main sources of equity capital, right? What are the main sources of equity capital? What are the main sources of equity capital? Equity means mainly, okay, retained earnings, shares, right? Or the, commonly you call shareholders funds, right? So there can be ordinary shares, preference shares, or the retained earnings, or everything you mentioned here, right? So that is equity, right? So company can use these equity sources, right? Share capital, both ordinary share and preference share, and retained earnings. And what are the debt capital sources? What are the debt capital sources? The company can use debt instruments, right? Debt instruments like debentures, in corporate bonds in many countries, but in our country, right, as we discussed, there are no corporate bonds. And in addition to that, they can use debentures, bonds, and loans, right? So that means the 2 points we discussed at the beginning, relating to direct finance and indirect finance, right? Relating to direct finance and indirect finance, that is debt instruments or the financial intermediaries, right? So company can use either financial instruments, right, equity or debt instrument, that is direct finance, or they can use indirect finance, that is financial intermediaries. They can take loans from the financial intermediaries. So these are the main sources the company can use to finance the project. The way of financing the project will decide the capital structure, right? The capital structure. And so there are, the company should identify the optimum capital structure. Because there is no rule, there is no generally accepted percentage applicable to all the firms that the organization should consider. This is the optimum level of debt, the optimum level of equity. There is no rule. That depends on the availability of these various sources to the company, and also the terms and conditions they have to agree. And based on that, the company will decide what is the optimum capital structure. We know there are number of advantages of using equity capital. What are the main advantages of using equity capital? What are the main advantages of using equity capital? right? Main advantages. Okay. Main advantages of using equity capital sharing. No fixed commitment. No fixed commitment, right? Because we know in the company use equity capital, dividend is not compulsory. In other words, dividend is not obligation. Dividend is not obligation. But when we consider debt capital, interest is obligation. So that is one main advantage of using equity capital. And what else? In addition to this, can you hold a take risk? Okay, for the organization, it is less risky because no fixed obligation for equity capital. What else? In addition to the dividend is not obligation, what are the other advantages? No dilution of ownership. It's a long-term capital. It's a long-term capital, and in addition to that, right? So that with that point, there is another very big advantage for the company, right? Because all the debt capital, there is a definite time period, right? At the end of that period, what should happen? They have to repay capital, right? So in fact, loans not only at the end, periodically they have to pay, but right, the other debt instrument at the end they have to pay the entire amount they raised, right? Right. Then okay. So there are a couple of questions. I will address. Right. And here, for all the debt capital, there is a definite time period. But equity capital, there is no maturity. And due to that, what is the main advantage? What is the big advantage? No need to repay. No need to repay capital. Right. Then so one can argue. Right. One can argue there are a number of advantages of using equity. Dividend is not obligation, no need to repay capital. But for the debt capital, interest is obligation, capital also must be repaid. So one can ask, then why company use debt capital? They can entirely use in equity capital. What are the reasons? Right. So you already mentioned the reason. Cost of equity is high. Then what will happen? Right? What will happen? The overall cost of capital will be high. And the other point also you mentioned clearly, the tax benefit. So these are two main reasons, and due to that, the cost of debt is comparatively cheaper, right? Comparatively cheaper. The cost of debt is comparatively cheaper. That is due to these two main reasons, right? The tax benefit on finance cost and the less risk, which means the less volatility of returns from the invest. Even though for the company, it is less risky to use equity, for the investors, it is more risky to invest in equity. And due to that, because you all know very well, there is relationship between risk and return. While it is more risky to investment in equity, for the investors, they require higher return. But the debt instrument, the returns are not volatile, right? That's why the debt instruments are known as fixed income securities. And due to that, so what will happen? The required rate of return is relatively low, right? Required rate of return is relatively low. And that's why you correctly mentioned the cost of debt is comparatively cheaper due to these two factors, right? Due to these two main factors, that is tax benefit on finance cost and less volatility of returns. And that's why if the company finance the entire investment used in equity, as you correctly mentioned here, right? Weighted average, the cost of capital will be very high, right? If the company has very high percentage of equity capital, right? And that's why all the companies use a combination of equity and debt. And so one of you have asked here, if the company has both debt and equity capital, if the question say project is funded from debt capital, right? So to analyze a particular project, what we should consider is the cost of capital relating to that project, not the overall cost of capital of the company, right? Because otherwise what will happen? So the new project, right? The new project, new project will not add additional value use, right? So when we are considering a particular investment, right? So we will consider very simple point. When you are making investment, right? When you are making investment, so you may have number of different investment. For each investment, right? Each investment should generate a return at least to cover the cost of that investment, right? Otherwise, what will happen? Otherwise, what will happen? Even though the overall return that you get from all the investment is positive, but if the return you get from one particular investment is less than the cost of that investment, there is no point. There is no point, right? So therefore, when we are evaluating a particular project, we should consider the weighted average cost of capital of that project. But if a particular project is financed using only one source of capital, we should use that, the cost of that particular source, right? When we are, in project appraisal, what situation we need to take the terminal value? Whenever there is a terminal cash flow, that should be considered, right? Because all the relevant incremental cash flow should be used. That means whenever it is expected that the company can sell the capital assets they acquire at the beginning, right? Once the project is completed, so it should be estimated, and we have to take that cash flow into the analysis, right? Which means we call it after tax salvage value, which is a definite important cash flow which should be considered. When there are different time period for projects, there are different techniques to do the analysis, right? So we can use okay, for that also if I right? So if the different time periods. So one question is there, when there are different time periods, different time periods. So here these are the two options. One thing is least common multiple of lives approach. The other thing is equivalent annual annuity approach, right? So these two methods can be used. So we can see what is the annual cash flows. The calculations like this are now fairly easy with, especially with the financial calculator, or even with Excel. We can calculate what is the annual value, what is the the present value per one period, right? Otherwise, this is fairly maybe traditional approach, least common multiple lives approach. But this is much easier and logical, right? To use this method, right? Equivalent annual annuity approach. So we can calculate what is the the value per annum, right? So that is what we have to do when there are different time periods. I'll show you with Excel how to do these calculations, right? Which is not difficult with this Excel when you are doing a real analysis. Especially, yeah, when there are projects relating to the different countries which involve different currencies. So this the exchange rate adjustments we have to do consider. We have to see the foreign exchange risk, right? When you are calculating the cost of capital, the way of financing the project should be used. Now this to finance the project, because this capital investment decision mean that's long-term finance edition. So here OD, OD rates, so that we should not consider, right? So we have to consider what are the debt capital, the long-term debt capital we use to finance the project, right? So therefore, we have to consider the cost of this debt capital used to finance the project. And so that should be considered in order to calculate the weighted average cost of capital. So when you know that when you are going to calculate the weighted average cost of capital, right? So when you are going to calculate the weighted average cost of capital, so when you consider the cost of all the sources used to finance the project, right? Whether the company is going to use ordinary share and whether they are going to use retained earnings or the new shares, and they are going to use any preference shares, right? Retained earnings and the debt, the long-term debt capital, and using that, the weighted average cost of capital should be calculated, right? And the weighted average cost of capital, because I mentioned earlier that we use different terms for the discount rate. Why we use weighted average cost of capital as the proper discount rate to evaluate the project? Because this shows the minimum return the project should generate. And that's why for the discount rate, we use these terms, commonly, the cost of capital and the required rate of return. So the required rate of return, so that is the minimum, the cost of capital, the weighted average cost of capital, which indicate the minimum return the project should generate to cover the cost of capital, right? The cost of financing that project. And if the project is expected to generate a return more than that, then only it will generate value it will increase value to the business. And that's why you calculate NPV to see whether there is additional value after covering the cost of capital, right? The cost of financing that project, right? So that's what we need to do. Okay, so so that therefore this financing decision should be taken, right? Should be taken with detailed evaluation, having identified the proper investment, proper sources of finance, right? Proper sources of financing, and based on that, it is necessary to decide what is the percentage of equity that should be used, what is the percentage of debt. Generally, as you all know, organizations generally identify a particular capital structure as their optimum capital structure, which they try to maintain. Whenever they finance new projects, they try to maintain, right? And then they try to increase the capital from both sources, right? That is to get the benefit of both equity capital and the debt capital. They try to maintain, they try to finance using a combination of equity and debt. And whenever they change the capital, they try to maintain this optimum capital structure. And so you all know, generally there is a preference for the organization when they raise new capital, when they raise capital for new investment, finance new investments. What is the first preference? Generally, organization prefer, okay, even before debt, right? Because the company, internal funds, right? Internally generated funds, right? Retained earnings. That is the first preference. And after that only, the company consider to use debt capital, right? Debt capital. And if the retained earnings not sufficient to finance the equity requirement, right, to maintain the optimum capital structure, they may consider to go for a new share issue, right? But new share issue, that is the last option, right? Because that is the most expensive and most, yeah. So they may consider other methods like right issue, right? And after that only, they will consider to make a new share issue. Because that is the most, because you are quite correct, because if the company issue new shares for each and every new investments, what will happen? That current share ownership structure, right? So will be affected, it will be changed. The current shareholders with the controlling interest will not be happy, right? So they are controlling power will be diluted. So therefore, initially, right, whenever there is a new equity requirement, they will consider right issue, and then only they will consider new share issue, right? And then, company consider to use debt capital. So they will always consider this the impact related to this equity and debt. The risk and return. Right. And working capital, we don't need to discuss in much detail because that is a point, a simple point which does not require detailed analysis or the detailed calculations which require financial mathematics, which is the analysis of the short-term assets and liabilities, which you all know, right? But here, the other key decision you also mentioned at the beginning, right? Dividend decision, right? That is very important. That is very important. And when organization is considering, when the organization is making the dividend decision, there are many important factors they should consider, right? Many factors organization consider, right? And when the organization is going to decide dividend, right? So you know that there are different factors they consider, right? So different dividend policies. Dividend policy as a residual decision, called residual dividend policy, shareholder clienteles, signaling effect, and you also call bird in the hand theory, right? So there are various factors the organization should consider in deciding the dividend policy, right? What is the meaning of dividend policy as a residual decision? Or you call it residual dividend policy. What is the meaning of that? Right? Any idea? What is the dividend policy as a residual decision? Right? What is the meaning? Right. If we don't have profitable projects, okay. No, actually, the dividend policy as a residual decision means once the company generate a profit, they will allocate the profit for the available profitable investments. The balance, residual, is paid as dividend. Right. Okay. Now, so that means the company pays dividend only with leftover earnings. That's correct. You know, that is the meaning, right? Because dividend paid after funding all acceptable new profitable new investments, right? So that is the meaning of the dividend policy as a residual decision, right? Dividend policy as a residual decision means once the company allocate the available profit, the current year profit for the available new investment, the balance is declared as dividend. So that is the meaning of dividend policy as a residual decision, right? And so another point consider when organization make the dividend decide the dividend, it's called shareholder clienteles. Because we know in a company there are different types of shareholders. Some shareholders expect regular return, dividend. Some shareholders expect capital gain. So organization need to consider the needs of all these shareholders, all the clients. So therefore, the satisfactory percentage of dividend profit should be declared as dividend. Satisfactory percentage should be retained and reinvest. So that is called the shareholder clienteles. Another point, signaling effect. You know that some generally organization, they don't change the dividend pattern significantly, right? So even if the profit decrease during a particular period, they don't decrease dividend significantly, especially decrease, right? They don't decrease dividend significantly in a particular year, even if the profit decrease. So sometimes what they do, they increase the payout ratio and try to maintain the same dividend pattern. The reason is, if the company decline dividend, that might provide adverse signal to the market, right? Adverse signal that the company's performance decline. So in order to avoid that, company try to maintain the same dividend, at least the same dividend amount or the dividend rate per trend, right? So that is called signaling effect. So that's why in some organization, payout ratio change significantly during certain periods. And another factor is relating to the dividend policy called bird in the hand theory. The point explained general perception of the shareholders, right? So we know the two returns, as you already mentioned, dividend and capital gain. So out of these two returns, while the capital gain is the more significant, or the, as far as the magnitude is concerned, the more significant return is capital gain, but the most certain return is dividend. So shareholders, right, generally prefers the most certain return rather than uncertain high capital gain. So therefore, what organization do? They declare satisfactory percentage every year. That's why this term is used, bird in the hand theory. The shareholders prefer certain dividend rather than waiting for uncertain capital gain. Bird in the hand worth more than two in the bush. And based on that concept, so that concept is used. So dividend policy, the dividend policy, that's very, very important. So there are number of important points that the organization should consider, right? There are a number of important points the organization should consider, right? The residual dividend policy, the dividend policy has a residual decision, shareholder clienteles, bird in the hand theory, a signaling effect, and in addition to that, very commonly used points by the organization. Some organization use constant payout ratio, some organization use constant dividend, constant or steadily increasing dividend. This is not the ratio but the amount. And some organization, they pay regular dividend plus some extra based on the profitability. So various factors, right? But whatever the conditions they consider, conditions they consider, one important thing, there should be a balance between dividend payment and retention in order to meet this main requirement, right? So I can I share this one also because this is include some points which I mentioned earlier relating to the market efficiency, right? Why still this direct finance, especially not very famous, not commonly used in right? Because now we know definitely in developing countries, indirect finance is most famous, as you mentioned earlier, due to these main features of efficient markets. The markets are not efficient, right? So that point also there, right? So now, considering these factors, it is necessary to take these finance decisions properly, right? So that is what the corporate decision is so important, right? So it's necessary to make this investment, financing, and dividend and working capital decisions properly to maximize the shareholders' funds, right? So we can use these main factors with some examples in this study text, which can be related to this your preceding material also, right? Since we continued for almost 2 hours, I think we can take a short break, right? Maybe about 10 minutes break, right? So then we'll try to apply the points we discussed so far relating to this corporate finance and key finance decisions. All right. I know you all are familiar with these calculations, but using some simple simple example, I'll try to explain this concept for anyone who has maybe, right, so may require some quick revision relating to this because that will be useful because right, so we can link this to the examples in the study text, and in fact in the case study you can see it's there is no particular project or the directly information not given yet, right? But you have to use this information when you are doing the analysis, right? But so we will try to relate this to the examples in the study text, and some examples we'll use to do this main analysis, right? So that so that you all familiar with this analysis, right? So that you can do the analysis clearly, right? Whatever the project that you have to analyze, right? So we'll see how to do these different types of analysis, right? right? And finally, we'll discuss some key points relating to derivatives, because this risk management part is also important. And as some of you asked already asked also, especially relating to this foreign exchange risk, right? For that also uh, on material, because here we don't have the time to discuss everything in detail, but so to right relating to this foreign exchange risk also some key points we'll try to cover, right? So we'll try to cover the basic analysis, the calculations, and the risk assessment, and derivatives and the foreign risk, the foreign exchange risk manage, right? Relating to this, we'll try to discuss, cover the key points, right? So let's take a short break. So let's start in uh, maybe 10 minutes. Okay. Right. Right. Okay. So let's see the analysis part. Based on the principles, right? We already discussed and the concepts. Because when we so when you get the information relating to a project, right? The important thing we have to identify only the relevant cash flows, right? So only the relevant cash flows, and then we need to identify the proper discount rate, and these calculations are fairly easy for you, right? So that you can do easily. But the important thing, right? So relating to these key project evaluation techniques, right? You all know about these techniques, right? So if I very quickly revise this, uh, because here I have summarized these main techniques which you mentioned earlier, that we use to evaluate capital investment. So you know very well. So to calculate ARR, we have to use these average earnings. That which is the limitation, right? So which is the main limitation in ARR, because that violates one main principle. Because here we know one main principle is the decision should be based on cash flows, whereas ARR is based on profit, right? And so the calculation is, see, you have to estimate the earnings, right? Average profit for the period of the project and calculate the average, which is simple average, right? Simple average. And using that, you calculate ARR. So the calculation of ARR is so easy, right? So easy, but very serious limitations there. And so this criteria, actually, you will see this criteria you use throughout financial management, analysis. Throughout finance analysis, you have used this. Not only in the evaluation of project, right? Now, when we consider, because there can be many investments in your analysis. So whenever you have to analyze a particular investment, this very simple point, which you all know very well, right? But you can say it is this concept is used consistently throughout finance analysis. Whenever you are going to make an investment, right? Whenever you are going to make an investment, so which is uh, important decision that you all make. We all have to make investment decisions, not only as organization but as individuals, right? You all make investments. So whenever we make investment, what is the criteria? What is the criteria? How do you decide whether that investment is worthwhile? It is better to do that investment. How do you decide that? Always, when you are going to make an investment, we need to, based on return, and what are the factors you have to compare, right? No, forget about key. Okay, all right. Forget about advanced terms, right? So normally, when you are going to make an investment, right, we have to see, right? So definitely, we have to compare the risk and return, right? We have to compare the risk and return, and so when you are considering the return, right, the return, any investment, when you are going to make any investment, uh, so we have to identify what is the return we can expect, right? What is the return we can expect? The return we can expect from that investment, right? What is the average return we can expect? Should be compared with what? Should be compared with what? Right? Right. So we'll be for a moment. I know you all familiar with this finance terms, right? So that's why even for a simple question you use all finance terminology. I mean, normally when you are going to make an investment, right? When you are going to make an investment, we need to identify what is the return we are going to get from this investment. That should be compared with what? The return we are going to get should be compared with return we return we are going to get, which means return we expect. Exactly. We have to compare with required return. required return. So this is the point I mentioned, not advanced terms. Normally, because this anyone knows this. Anyone knows this, right? Simple point. Very practical thing. Whenever you are going to make a particular investment, we need to identify what is the return we are going to get. What is the return we need? In finance, we use the term expected return and required return. Right? So here, even this ARR relating to that. ARR means what? It is the return we are going to get from this project, right? Based on our estimate. This is the return we are going to get. Expected return, right? But based on the risk, which you know here, all the relevant points you have included in your answers, right? But I asked from very simple term, right? From very simple term, very simple point that we all do. When we are going to make anything, what is the return we need, right? And what is the return we are going to get? Then we can compare and decide whether we should do this, right? Whether we should invest in this particular alternative. That's what we have to do. Okay, so then this criteria is purely based on that condition, right? So ARR. So that is the return we are going to get. We can expect, right? That is the return we can expect from the investment from this project, and according to the risk, what is the return we require? So to estimate the required rate of return of different types of investment, we use different models, right? Normally, to identify, right, very commonly, but not limited, right, to identify the return we require for a share, what is the very commonly used model? You all familiar, I know very well, right? But that's why I mentioned it is not limited to a share, right? It's not limited to share. It can be used to many other investment. CAPM, right? CAPM. So that's what, as you mentioned, CAPM. So capital asset pricing model, that is a very commonly used model to identify the return we require from a share, but not limited to share, right? That's why I mentioned CAPM can be used to identify the required rate of return for any investment. For a portfolio, right, we can use, but it provides very rational basis, right? Because that's why capital asset pricing model, that is the earliest asset pricing model, right? It was developed in 1960s, right? 1960s, right? This Sharp, Lintner, Black machine. So they developed 1960s. So single factor asset pricing model, but it was, later number of multi-factor asset pricing models developed, right? What are the multi-factor asset pricing models very commonly used or popular multi-factor asset pricing models, right? What are the popular asset pricing multi-factor asset pricing models? Okay, maybe not covered in started exams so far, right? Pharma French 3-factor model, Pharma French 5-factor model, Cahart 4-factor model, right? So these multi-factor models develop, but the foundation used to develop capital asset pricing model has not been rejected. It's very logical foundation, which is based on the foundational groundwork of Harry Markowitz, efficient frontier, right? So which you have learned in portfolio theory, right? The capital market line and efficient frontier. So based on that, so therefore that foundation, that logic has not been rejected. The assumptions were criticized, right? Assumptions criticized, but logic has not been rejected. The foundation has not been rejected. So even though number of multi-factor asset pricing models develop, and that's why that provide very logical basis for the required rate of return. Actually, whatever the technique we used, you will see these investment decisions based on that important concept. So whenever the terms may be different. The terms we use for the different analysis may be different, but the foundation, the concept is same. So whenever you are going to make an investment, we compare, right? We compare the return we require with the return we can expect. What is the return we are going to get? What is the return we require? And that's why when we are doing the project evaluation, ARR is, right, based on our estimate, that is the return we are going to get. But based on the risk, what is the return we require? We compare. right? So what is the criteria to accept? The return we are going to get should be more than the return we require. At least should be equal, right? So that is the simple principle. You will see, right? That is the simple principle we use in many analyses, not only in project evaluation. In CAPM, you compare the required rate of return and the estimated return. Uh, so let's consider bond evaluation. Bond evaluation, right? When you are evaluating a bond, you calculate, I mentioned earlier, yield to maturity. Yield to maturity means what? Yield to maturity means simple. What is the simple idea? What is the simple idea? Okay, the finance term is IRR. I mean, what is the simple idea? That shows if we buy a bond at the current price and if you hold the bond till the maturity, what is the return we are going to get? What is the return we are going to get? Right? That is like expected return, right? That is like expected return. When you calculate the yield to maturity to decide whether it is worthwhile to invest in that bond, yield to maturity you have to compare with what? Yield to maturity you have to compare with what? Right? Yield to maturity means IRR, right? So yeah, required rate of return. Required rate of return. Generally in the analysis of a bond, for the required rate of return, what is the rate we use? Okay, you already mentioned market return. Market return, right? For the required rate of return in the analysis of a bond, we normally use market interest rate, right? Market interest rate we use as a basis for the required rate of return, right? In the evaluation of a bond, for the required rate of return, we generally use market return, market interest rate. And therefore, once you calculate the yield to maturity, right? Once you calculate the yield to maturity should be compared with the market interest rate. That is the required rate of return, right? Same thing, right? Same thing. You can see only the letters are different, only the terms are different, but the concept is exactly same, right? So in the evaluation, in the analysis of CAPM, right? In the analysis of CAPM, right? So we do the same thing, right? We do the same thing. When you are analyzing CAPM, when you calculate the required return using the CAPM, we compare with the expected return. We can identify whether the investment is acceptable, right? So you can see these different finance analyses, finance concepts, but we do, right? We do the same, we use the same concept, right? We use the same concept. Right. So ARR. So when we calculate average earnings, we calculate average earning as a percentage of initial investment, and then we can see whether the project is acceptable. When you calculate the payback period, right? Payback period. It's the period required to recover the investment cost. We compare that with the cutoff period, right? So benchmark period, minimum acceptable period relating to a particular company. But we know the main limitation, right, relating to the payback period. So there is no principle to decide this cutoff period. So it can lead to manipulations. It can lead to manipulation. In addition to that, payback period, right, so also has some serious issues, serious limitations, right? And so these things I'm not going to discuss because you all know these things very, very clearly, right? So ARR, the main limitations, time value of money is not considered. The decision is based on profit. And payback period also, time value of money not considered, but it can be eliminated by calculating what? Discounted payback period, right? And so these points, NPV, right? No need to discuss. What are the limitations of NPV? Any limitations of NPV? Because NPV is a very good technique, right? Very good technique to evaluate a project, right? But what are the limitations of NPV? Any limitations? right? Any limitation? This projection of cash flow, that is actually not limited to NPV. So therefore, we can't consider it as limitation of NPV, right? Because that is a challenge which I mentioned earlier, right? That is the most important thing, the biggest challenge, which is applicable to all the techniques. It's not limited to NPV, right? So the main issue with NPV. Okay, here I saw some, let's say, so one of you mentioned difficult to calculate. It's not, NPV is not difficult to calculate, but what is the additional difficulty? The estimation of discount rate. That is the difficult part, right? I mean, difficult part means additional difficulty, right? So and okay, so one of you have mentioned another point, discount rate. It is considered it remained constant, right? So and so this doesn't consider the size of the project. That is mainly that issue arise when you are going to compare, right? When you are going to compare, this problem is there, right? Cash flows after project finishes not considered. No, that's not correct. That's not correct. So when you are calculating NPV, all the cash flows should be considered, right? Capital rationing, that's true, right? Capital rationing, heavy reliance on estimates and assumption, that is not limited to NPV. That's a challenge, right? Accuracy of cash flow, those are not limitations of NPV. Discount rate, that is the main point, right? So the main limitation with NPV is the estimation of the discount rate is the challenge, the difficulty, right? And the other point also you have mentioned, it is assumed the discount rate remain constant, which is also a limitation, right? And another point which you have mentioned, especially in the case of capital rationing condition, NPV can't use to rank the projects, right? But the other things, non-financial factors, those are relating to all the techniques, right? Because those are the challenges relating to all the techniques. So the main problems with NPV, particularly the difficulty in estimating the discount rate, it is assumed the discount rate remain constant, and in capital rationing situation, it is not possible to rank since it does not consider the investment size. That's what you have mentioned. Those are the main limitations, right? IRR, you all know the meaning of IRR, right? So what is the meaning of IRR? What is the meaning of IRR, which you all know? It is the discount rate at that generate zero NPV, right? As you all know, which is a very, I mentioned earlier also, IRR is a very useful technique, right? Not only to evaluate the project, but also to make number of other important finance decisions. NPV important, IRR is important, right? So that's why even in capital rationing situation, IRR can be used as it is, right? IRR can be used. So that's why IRR is a very useful technique. What are the limitations of IRR? What are the limitations of IRR? Multiple rates, which is okay, double IRR or multiple rates. Is it a common problem? Is it a common problem with IRR? Multiple IRR. Is it a common problem with IRR? That can arise very, very rarely, right? It's not a common issue. But okay, here, so one of you have mentioned the main problem. This is the main problem. It is assumed that cash flows are invested at IRR. That is the main problem with IRR. Reinvestment assumption is not realistic, right? Reinvestment assumption is not realistic. So that is the problem with IRR, right? That is the main limitation of IRR. Reinvestment assumption is not realistic. Reinvestment assumption is not realistic because we know IRR is not a market determined rate. Because whenever there is a series of cash flows, right? Whenever there is a series of cash flows, right? So you know that there is one assumption we commonly use, right? There is a commonly used assumption when there is a series of cash flows, right? That means it is assumed that initial cash flows can be reinvested at IR, at the discount rate. So for NPV, the discount rate is cost of capital, right? As you all earlier mentioned, weighted average cost of capital, which is decided based on the current market condition. We know since it is assumed it is remain constant, it is not correct. But at least at the time of doing the evaluation, that is correct, right? That is realistic, that is logical, right? Because discount rate is the cost of capital, weighted average cost of capital, when we calculate NPV. But in IRR, the discount rate is IR, right? So therefore, if when we use IRR, it is not correct to say that it is possible to reinvest at IRR, right? So there are certain, adjustments that we can do, like, modified IRR, so like that. But still, the main problem with IRR is, the main limitation with basic IRR is the reinvestment assumption is not realistic. That is the problem, right? That is the main problem. That is the main limitation of IRR. Reinvestment assumption is not realistic, right? So then this multiple IRR you also mentioned, right? But we know this multiple IRR or no IRR, these problems are very, very rare. Very rare, right? So only when there are projects with unconventional cash flows, these problems can arise. Therefore, these are not common problems. The main issue with IRR is the investment assumption is not realistic. But IRR is useful. Because IRR, okay, here one simple example I have used, but I'm not going to do this calculation too basic. Sort of, if I try to do this calculation here, it is like I'm insulting group of, chartered accountants in few days, right? So therefore, I'm not going to do these calculations here, right? But you know very well. So how to do these payback calculations relating to payback, NPV, IRR, and different techniques, right? Now, NPV. So this is we know this is the main formula, but using the discount factor, using Excel, you can easily calculate, right? You know how to get this discount factor in Excel and do the calculation, right? Anyone needs to show that calculation? Otherwise, right? So you all know, right? You all know that. So therefore, no need because here we know the calculation. This discount rate, discount factor, you can very easily calculate using Excel, and NPV can be calculated easily, right? So therefore, and in addition to that, even using Excel inbuilt formula, you can calculate NPV, right? So NPV formula there, and using that also, you can do this, right? So you are familiar with this, right? If anyone needs, I can do that, right? Otherwise, we can see the analysis part, right? No need, right? You all know these things, right? Okay, so here, so then once you, okay, so how to do in Excel, right? So that's easy. Okay, now here actually these are the final outputs, right? So that means once you do all these calculations, right? Once you do all these calculations, and once you get the final net cash flows like this. So this final part. So I have taken to this simple example. So when we get the final net cash flow for each period with the discount rate, so you can easily do, right? Okay, the calculation of this discount factors, of course, there is no any difficulty. So because it is 1 divided by the calculation of the discount factor, right? So 1 plus the discount rate to the power period, right? So it is just matter of making the interest rate constant, and so then when you get the discount rate, you easily get NPV, right? And the calculation of NPV using inbuilt formula. So it is so. 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 use here. Right. So to calculate NPV, right. So using this NPV formula. So when you type NPV, right? So when you type NPV and double click, so you get this automatically. So only thing you have to do, you have to give the rate. Now in this example, the rate is 12%, right? And then so one issue with my laptop, some keys are not working now. So that's, so here there was an issue earlier yesterday. So what? Okay, so I show this. Right. So this is what you have to do, right? So you have to press equal type and then give the discount rate and then select all the cash inflows, right? So select the cash inflows and then close bracket and then add the investment cost. That's what you have to do, right? So the calculation is so easy, right? Equal NPV and double click, you automatically get this. So it's just matter of indicating the rate and select the cash inflows, right? And close bracket and then add the investment cost. So you get NPV easily, right? So using the inbuilt NPV formula or using Excel, this discount factor calculation, so you can do it easily. And IRR also, right? So here IRR calculation easy. So IRR, so inbuilt function is there. It's just matter of selecting the cash flows for the project. You can easily do that, right? You can easily do that. Okay. And then once you right. Okay, here, so especially when you have to, here comparison, right? So comparison is there even in that, we'll refer to that particular example in the study text also, right? So here, when you need to do a comparison, right? Okay, here, in fact, when you calculate NPV, now in this case, the comparison is simple. So here, the two projects with the same investment cost, even with NPV, we can do the comparison. But we can't compare if the investment costs are different, then we can't compare using NPV. So when you calculate NPV, here I have used this discount factor formula and everything is linked. So therefore, we can easily see the impact, right? IRR is calculated based on this inbuilt formula. Now, here, so you can see if you have to compare the projects, right? So we know both NPV and IRR will give you the same result for a single project. For a single project, if you calculate NPV and IRR, the answer will be definitely same, right? That means, if a particular project has positive NPV means what? Definitely, IRR is greater than cost of capital, right? So there is no doubt, right? There is no doubt. If IRR is greater than cost of capital, IRR is greater than cost of capital means what? NPV is positive. So there is no conflict between NPV and IRR ranking for a single project. So when you calculate NPV and IRR, the answer will be same. The result will be same. But if you have to compare two projects, mutually exclusive projects, there can be a conflict sometimes, right? So to identify that, one technique you can use is called NPV profile. You all know the meaning of NPV profile, right? What is NPV profile? What is NPV profile? What is NPV profile? Any idea? NPV profile? Because one very useful method, especially when you are comparing projects. When you are comparing projects, it is a graphical presentation which shows the relationship between what are the variables, which factors. It is the graphical presentation of the relationship between NPV and cost of capital, right? NPV and cost of capital, right? So, so it is like this. It is like this. So, okay. So I will use NPV profile of only one project for a moment, right? So NPV profile means this. NPV profile means, right, as you mentioned, it is the graphical presentation of the relationship between, no, it is not profitability index. It is not the profitability index, right? It is the graphical presentation of the relationship between NPV and cost of capital. Because when the cost of capital is low, NPV is high. When the cost of capital increase, NPV decrease. The point where the NPV profile crosses the vertical axis. What is that point? What is the point? The NPV profile crosses the horizontal axis. IR. That is IR, right? The point where the NPV profile crosses the horizontal axis, that is the cost of capital axis, that is IR. That is IR, right? So, it shows, right? So that's why I mentioned earlier, for a single project, NPV and IRR will give you the same result, right? Why? Since this is the IRR of this project, at any discount rate below that, NPV is positive. At any discount rate beyond that, NPV is negative. So that means if cost of capital is less than IRR, NPV is positive, right? So NPV positive or IRR is greater than cost of capital means same thing, right? So single product or single project, it will give the same answer. But if the projects are mutually exclusive, if you compare two projects, we can see whether there can be a conflict. Whether there can be a conflict, right? So simple point based on the concepts you already know, right? But this is useful, right? Now here I have used two very simple projects, right? But when you draw the NPV profile of two projects in the same graph, you can identify if the cost of capital change, can there be a conflict? Now for these two projects, is it possible to have a conflict at different discount rates? Just by looking at NPV profile, you can say. Can there be a conflict if there is a change in the cost of capital? Yes, right? Because if the NPV profile of the two projects cross each other, there can be a conflict, right? Because we can see currently is there a conflict at the current cost of capital? Is there a conflict between NPV and IRR rankings? Is there a conflict currently? Right? Currently there is no. Currently there is no, right? The project with higher NPV also has higher IRR. Because you know, higher the NPV is better, higher the IRR is better. So at the current discount rate, there is no conflict. But if the cost of capital change, right? Since I have linked here, so this NPV profile, NPV values will change, right? This NPV values will change, right? Now, if the cost of capital is 5%, can there be a conflict? Can there be a conflict between NPV and IRR rankings? Is there a conflict? No? Yes, right? There is a conflict. Now, what is the project with higher NPV? Project Y has higher NPV. But IRR of project X is high. So according to NPV, right, because we know generally NPV we can't use as it is to rank the projects. But here, since the investment same, we can consider that also. So based on NPV, project Y is better. Based on IRR, project X is better. So if the cost of capital change, there can be conflict. And that's what you identified earlier without doing any calculation, just by looking at the NPV profile. Just by looking at the NPV profile, you identified that the project, there can be a conflict. There can be a conflict between NPV and IRR rankings, right? There can be an NPV and IRR conflict between NPV and IRR rankings if the NPV is a cost of capital change. So that can be identified easily when you draw the NPV profile of several projects in the same graph. If the NPV profile crosses each other, there can be conflict. So you can even identify this crossover rate. What is the rate that the NPV profile of the two projects cross each other? Anyone knows how to do that? How do you calculate the crossover rate? Right? How do you calculate the crossover rate? right? The crossover rate is the IRR of incremental cash flows. Incremental cash flows. Right now, for these two projects, if we use the incremental cash flow, you know the meaning of incremental difference. Now, the investment, of course, there is no difference, right? Investment, there is no difference. Sorry, not this one. I have to use these cash flows, right? So investment, there is no difference, right? So the incremental cash flow is 0. But other years, there is a difference, right? Okay, so I can directly do this one. Right here. So these are the incremental cash flows. So if you calculate the IRR of incremental cash flows, right? IRR of this incremental cash flow, that is the crossover rate. This is the crossover rate. Okay, this is the crossover rate. So when you have to analyze two projects to identify whether there can be a conflict between NPV and IRR rankings, right? So to identify whether the NPV profiles of the two projects cross, and if the two projects, NPV profiles of the two projects cross each other, what is the crossover rate? You can calculate this way. It is the IRR of incremental cash flows of the two projects. So how do you know whether this is correct? You should not accept just because I mentioned. So I said the IRR of the incremental cash flow is the crossover rate. So how do you know whether this is correct? If this is correct, what should happen? If this is the discount rate, what should happen? NPV of the two projects should be equal. NPV of the two projects should be equal. So we can check that. We can check that, right? So here, so if I use this as the discount rate, what should happen? These two should be equal, right? These two should be equal. So we can check. That's right. That's correct, right? So now you can accept. So what is the crossover rate? Crossover rate is IRR of the incremental cash flows. So when you need to compare, right? So when you need to compare two projects, and so NPV profile provide useful method, right? Useful method to compare, right? Useful method to compare. And when you are going to compare, right? So it is easy to draw this NPV profile. Actually, to draw this using Excel, I have calculated many times, right? Several times. But you don't need to calculate NPV's number of times to draw the NPV profile. If you draw this manually, right, you need only a few seconds. Once you calculate these initial values, right? When you calculate these initial values, right? I mean, when you do this basic calculation, to draw the NPV profile, you need only a few seconds. The only thing you need to know, what is the NPV of the project if the cost of capital is 0, right? We know cost of capital will not be 0, but cost of capital 0 means what? Cost of capital 0 means what? You don't need to discount. You don't need to discount. If the cost of capital is 0, what will be the NPV of project X, right? It is simply difference between cash inflows and outflows, 3,500. And what is the NPV of project Y? 4,000, right? No need big calculation, right? So you know the value of NPV if the cost of capital is 0, right? So it is 3,500 for project X, 4,000 for project Y. And other point, you already know, right? We know when the cost of capital increase, NPV decreased, and you know the point where the NPV profile crosses the horizontal axis, cost of capital axis. What is that? As you mentioned earlier also, that is IRR. So when you know the IRR, so IRR of project X is 18.03%, and only those 2 points you need to draw the NPV profile, right? I mean, approximately, right? So to see whether there is a conflict, because here the NPV profile of X start at 3,500 and it crossed the horizontal axis at 18%. NPV profile of Y start at 4,000 and it crossed the horizontal axis at almost 15%. You can see easily whether there is a conflict. Is that clear? Is that clear? Right? Okay. So very easily, right? So very easily you can see when you are going to compare projects, right? Very easily you can identify right? You can easily draw the NPV profile of several projects. Line is curved. Okay, why is that? Okay, so this concept. The line is curved. Line is curved because here this concept actually again this concept is used in several places. When you discount several cash flows, right? Definitely, what is the relationship? The relationship is non-linear, right? The relationship is non-linear. So whenever you calculate NPV, right, at different rates, and if you draw the graph, curve is this line is non-linear, and yeah, that's what I mentioned. So only these 2 points you have to identify. If you draw roughly, so you have to draw non-linear curve approximately. Otherwise, to draw precisely, we have to get the values at different rates. But here you can see with Excel that's easy. You need only a few seconds, right? Only a few seconds. You have to change right here. What is the NPV? If the NPV cost of capital 5%, we need to mark that, right? 10%. We have to mark that. So with Excel, it takes only a few seconds to get these values and draw the graph, right? You can easily do that with Excel, right? To draw it easily. Otherwise, approximately, manually, you need only these 2 points. Only these 2 points you need, you can roughly do. And it is curved, right? It is non-linear. It is non-linear. So definitely, when you calculate NPV, right, using some, like this, and when you calculate NPV, it is non-linear. We do this. In okay. So decision criteria. So actually, so here, whenever we need to decide when there is a conflict, right? Whenever there is a conflict. Okay. First of all, why? What is the reason to arise the conflict? What is the reason to arise the conflict between NPV and IRR? Right. The reason is the different reinvestment assumptions, because NPV assumes interim cash flows are reinvested at cost of capital, but IRR assumes the interim cash flows are reinvested at IRR, which is the major limitation of IRR, right? Actually, the decision, the criteria, which is an important point, right? And actually, so here we know when we are comparing projects, especially the projects with different investments, right? NPV is not the correct technique, right? So we have to use either profitability index or IRR. So right, whenever there is a conflict, whenever we have a rationing situation, right? So we have to use either profitability index or IRR, and especially when there is a complete condition like this, the investment is same, right? Then of course profitability index also will be directly related to that. So therefore NPV and profitability index, there will not be a difference, right? I mean the ranking, there will not be a difference. So in that case, right? So here, so the decision may not be very straightforward. So here one thing we should consider, actually IRR is always a better technique whenever we do the comparison. Whenever we do the comparison, when we are compare projects, because IRR is the better technique, because it shows not only whether the project is acceptable, it shows whether the project is safe. Because now we can see that clearly from this example also. Initially, we have done this analysis based on 12% cost of capital, and we got this. And you, right, when you get the IRR, so IRR of X is 18%, Y is 14.96%, almost 15%. And you know definitely, out of these two projects, what is the better project? You know definitely what is the better project? Very simply, X is the better project. Now, you know the reason, right? Not only because NPV is higher, IRR is higher means what? This project is more safe, right? What is the meaning? As we discussed earlier, this analysis entirely based on what? entirely based on estimates, projections, assumptions. So the cash flows can change. Discount rate can change. So what is the maximum level the cost of capital can increase for the project Y? To be considered as the project is acceptable, what is the maximum level cost of capital can increase? 4-year project. So during this 4-year period, right, there is a room to increase the cost of capital only up to, right, 14.96%. 14.96%, right? Because if it, 15%, right? So let's say 15%. So if it increased to 14.96%, what will happen? NPV will be 0 of project Y. But what about project X? It will still generate positive NPV, right? And that's why you mentioned earlier, project X is better, right? Project X is better, right? Even if reinvestment assumption of IRR is not realistic, that serious issue is there, right? That limitation is there. IRR is very useful because that indicate whether the project is safe. See, even if the cost of capital increased to 15%, this will generate positive NPV, right? So the project X will have 0 NPV only if the cost of capital increased to this level, right? But if that happens, you can see the cost of capital, so the NPV of project Y will be significantly negative, right? Very significantly negative. So that's why we consider this IRR is useful, right? So we can see the importance of IRR, right? So IRR, while it has limitation with that assumption, reinvestment assumption, that's a very useful technique. It indicates not only whether the project is acceptable, but it indicates whether the project is safe. So that's why whenever we are going to rank the projects, right? Whenever we are going to rank the projects, we can use IRR, right? We use IRR to rank the projects. So is that clear? So whenever there is a comparison, so IRR is the better technique. Right. Okay. Then, all right. So with principles we already discussed. This is one good method, but not essential, right? One good method when you are analyzing cash flows. So, one method I consider very, very logical, because when you are doing an analysis, evaluating a project, it is better to do it, very logical and clear way. So therefore, one good method to classify the cash flows. Classify the cash flows. So clear, right? And I mean, the analysis is very clear. And even if you want to do the risk assessment, you can do that with clear understanding, proper meaning, right? So the investment outlay. So the three stages: initial investment outlay, annual after-tax operating cash flow, and terminally after-tax non-operating cash flow. So the classification is good, not essential. So sometimes the way you have done may be different, right? But doesn't matter. So whatever the method you do that, you get the same answer, right? So there is no issue. But this is one good method. We can classify the cash flows. The analysis will be clear. And when, why it is clear, even if you want to do the risk assessment, because we know when you do this basic analysis, right, as we discussed earlier, right, when you calculate the NPV of a project, under the current cost of capital, this doesn't mean that this project will definitely generate net present value of this, right? That is not the mean. This is based on this basic analysis. But we know this value can change. This value can change, right? And that's why, we need to analyze the risk. And two important and two commonly used techniques are sensitivity analysis and scenario analysis. Sensitivity analysis, as the term implies, we have to identify what are the main factors that can affect this particular project, right? So when you do this analysis for a real project, it is better to do this analysis in detail with clear workings, clear, detailed calculations, right? So for a particular project, in addition to this main, initial investment, working capital, there may be several other key factors. The company, what is the quantity company planning to sell, and what is the expected selling price, what is the expected variable cost, what is the expected fixed cost. All these key variables you have to consider. Now, when we do this basic analysis and we calculate NPV, right? When you calculate the main NPV, right? NPV and IRR based on the main basic analysis, right? So when you calculate this, right? So when you do this basic analysis, but we can see if a certain factor change, what is the impact? And that is what we call sensitivity analysis. What is the sensitivity of changing a particular variable? So here we are going to change only one factor at a time. And we use a certain fixed percentage. Now, for this example, I have used 20%, right? So that percentage should be used consistently for all the key factors relating to a project, right? Relating to a particular project, all the key factors should be used, right? Separately, we have to analyze. So we can see, right, after we do this basic analysis, we can see if the unit sales decrease by 20%, what will happen to this original calculated values? We can't do this manually, because you know very well, if the unit sales change, what will happen? If the unit sales change, everything will change, right? Unit sales change means revenue change, variable cost change, profit before tax change, tax will change, after tax change, everything will change, right? So can we do this manually? It is not possible to do this manually. So when we need to do a sensitivity analysis, we can use a simple Excel sheet like this. And when we do this basic calculations with the proper link, right? So we have to link each part. And then to do the sensitivity analysis, you need only a few seconds. Now, if you want to see the impact, if the unit sales decrease by 20%, right? You need to change only one cell. Only one cell you have to change to see the impact. Everything will be adjusted and you can see the result. Unit sales decrease by 20% means what you need to do? The value, this cell should be multiplied by decrease by 20%. That means multiplied by 0.8, 80%. Right? So we have to multiply it by 80%. So when you multiply this by 80%, everything will be adjusted. We can see the result. What happened? NPV changed to minus 458 and IRR changed to 14.7, right? Which was, NPV initially, according to the best case, it was 11,871 NPV. But now, if the unit sales decrease by 20%, this will be NPV. This will be the value of NPV. And this will be IRR, right? We note down this and then we can see if the unit sales increase by 20%. Again, we have to change only one cell. Unit sales increase by 20% means we multiply by 1.2. We multiply by 1.2 and we can see the result. The net present value will increase 24,200. IRR will increase to 32.2%. We note down this. So in this way, we change the value of a variable, right? Value of one variable at a time. And then we note down the result. Price decreased by 20%, right? We change the price. So we change the price, decreased by 20%. So what is the result? What is the impact, right? So that is the impact. So this is what we need to do. So after we do the basic analysis, and we can easily do this sensitivity analysis. The value of each variable we change at a time, and we record the result. We record the impact to these variables. Now, so this is the result of the sensitivity analysis for this project. This is the result which I have summarized. And what is the importance of this? When you do this sensitivity analysis and when you get this result, now we can see what are the most Okay, I already mentioned. So at the end of this session, I'm sending these materials to the institute. So which will be which will be communicated to you, right? Okay. So then once you get this, once you get the result of the sensitivity analysis, right? Once you get the result of sensitivity analysis, what we can do, we can identify what are the most important variable, most sensitive variable for this project, right? So when you look at the result of this sensitivity analysis, right? What is the most sensitive variable for this project? What is the most sensitive variable for this project? Right? So here, this is the result of sensitivity analysis, right? The impact of changing the value of each factor is explained here. The most sensitive variable is price. Okay, someone has mentioned variable cost. Is that the most sensitive variable? Variable cost, actually, the negative impact is there for the company if the variable cost increase, right? If the variable cost increase by 20%, what will happen? NPV change from 11,800 to 3,600, but still positive. But as many of you have mentioned, the most sensitive variable is price. See what happened? If the price decreased by 20%, what will happen? Positive 11,800 NPV will decrease to negative 8,600. Right? That means, what is the meaning? If the price that we have estimated is not correct, what will happen? Our entire analysis will be wrong. Right? If the actual price we can sell this product is less than what we expected, now we are recommending to accept the project which is not acceptable at all. It's totally unacceptable, right? Is that clear? Right? Is that clear? So if the estimation of price is wrong, right, say, it's a totally unacceptable project, right? If the actual price we can sell this product is not 50, but let's say 40, what will happen? See, the project is not acceptable at all. It will have a very significant negative NPV. But we have estimated we can sell this product at 50, and we have recommended to accept this product. So which means, what is the most sensitive variable? Price. Then what the company should do? They need to do further evaluation, further analysis to make sure the price they have estimated is correct. They need to do further analysis, market survey, right? And to make sure the estimation of price is correct. Right? If the price they have estimated correctly, then okay. Then no problem, right? But otherwise, it's a totally unacceptable project. Right. Then what is the next sensitive variable? What is the next sensitive variable? Right? After price, quantity. Quantity, unit sales, right? Unit sales, quantity. That also you can see positive NPV change to negative NPV. So it's also important. So therefore, unit sales also, company should analyze, right? Do further study, further analysis to make sure it has been properly estimated. What is the least sensitive variable? Least sensitive variable. The least sensitive variable is it fixed cost? Salvage value, right? Salvage value. The least sensitive variable is salvage value. It's not the variable cost. Variable cost also here, it changes significantly, right? But the least sensitive variable is salvage value. Yeah, not variable cost. Variable cost also important, significant, right? Here, variable cost not as sensitive as price and unit sales, but there is a significant impact. Least sensitive variable is salvage value. See, even if decreased by 20%, NPV change only from 11,800 to 11,000. Right? The least sensitive variable is salvage value. So therefore, even if the actual price they can sell at the end change slightly, decrease slightly, that will not make much impact. So the estimation of salvage value, that is not very serious. But the main issue is the estimation of price and unit sales. So is so important, so crucial, right, for this project. So like that. Now this is for this project, this example. When you are evaluating a project, you have to see the impact of changing the main factors, main variables, and what is the impact to the originally calculated values. It should be identified, right? So that is called sensitivity analysis. In addition to the sensitivity analysis, there is another concept known as scenario analysis. Scenario analysis, there what we do, right? There we have to change all the factors. In fact, this is the question I have analyzed there, right? This material also I'll share with you, right? This is the material I have analyzed there in Excel, right? So this basic NPV and IRR, which I have estimated here, right? And then if you, the other analysis is called scenario analysis. That means if the entire scenario change, we do the basic analysis under the base case, right? Under the original estimate. Initial investment, of course, it is not difficult, right? Because initial investment, of course, that can't change, right? Because it is the amount that will be cut at time zero. For the initial investment, everything can be identified precisely, right? Am I correct? Because you can even get that means if you are going to purchase some capital investments, it is possible to get a quotation so from the suppliers. So that is fairly certain, right? Time zero. So therefore, it is not necessary, right? It is not necessary to see because that can be identified precisely, right? Accurately, we can identify, which may not necessary to do the sensitivity analysis. I mean, to see the impact. As long as we have identified the method of acquiring all the capital investment, or if there is any consultancy fee, as long as we have agreed with another party, licensing, registration, right? So these are fairly fixed, right? This may not change. But if the company planning to accept this in the future, right? So then might require certain adjustments. Right. So scenario analysis means if the entire condition change, entire scenario change. So we do the basic analysis under the base case, but if everything change unfavorably, worst case, what will happen? If everything change favorably, best case, what will happen? Right? So that analysis can be done. Right? So there are all the key variables we have to change. Right? So that's also not difficult. So we have to refer to the main analysis, but all these key variables we have to change and see the impact. If everything change, what is the impact? Unfavorably, right? If everything change unfavorably, what is the impact? If everything change favorably, what is the impact? Right? So we can identify the impact. And that is called the scenario analysis. That is called scenario analysis. Here you can, right? So when you have to analyze the risk of a project, that can be done. And the capital rationing, right? So which is a very common concept that will be checked, right? So it can be calculated. But I saw that. So how did you calculate the profitability index in your exams? You calculate as a percentage or as a certain amount, like certain value like this. So suppose NPV, and you calculate this way or as a percentage in your exams. As a percentage, right? As a ratio. That means here you didn't calculate. You didn't use. You didn't calculate. You didn't add initial investment, right? That means you calculate the profitability index this way. Sorry, right? If I write this way, okay. So this is how you calculate NPV, right? Sorry, profitability index. Is this the way you calculate it? right? This as a percentage, right? Okay, so that's okay, because see, in different finance books there are different approaches, but the interpretation will be same, right? Interpretation will be same, all right? The method, so we use in some other finance books. So this is the method, right? So we calculate the profitability index. So here we get 1 point. If the NPV is positive, we get 1 point something, right? Like that. But here, okay, so you have calculated as a percentage, no problem. So, but still we can see, you know, you can see, okay, that means if a particular project has a negative NPV, definitely the profitability index will be minus, right? So you get a minus value. So, but here, according to this method, it will be less than 1, right? Okay, so that method you can continue, because that is the method. So it is explained in this study text also, right? So here, this is how you calculate profitability index, right? NPV divided by initial investment, you calculate as a percentage, right? This is how you calculate, right? Okay, then it's okay, no problem, right? So you can do that way also. So higher the percentage, yes, higher the percentage, better. So which means for the investment, as a percentage of investment, NPV shows higher percentage, right? For the investment made, the NPV shows a higher percentage, then it is better. So that's why it's called profitability index. That's good. And so one thing, when you are comparing, right? So when you are comparing, always use either profitability index or IRR, right? Because to compare projects under capital rationing, right? To compare projects under capital rationing, it is not very correct. It's not very correct to use NPV, right? Especially when the investment cost is different. So when the investment cost different, right? So it is not correct to rank using NPV, right? So which is not logical. That is not logical, right? So here we have to see, and the other thing, so which is clearly explained here also, the objective should be to maximize overall return to the organization. So company should identify the best combination of the projects that will maximize the return, right? That will maximize the return to the organization, right? So that way it should be identified, right? It should be identified that way. Right. So in capital rationing situation, so you know how to do that. So you know how to analyze and the principles, right? And the key techniques to evaluate the risk, and also in capital rationing situation, so how to rank the projects. So to decide the cost of capital, already certain points we discussed, and so the detailed calculation of the cost of capital, right? Because it is purely based on the calculation of the cost of various sources of capital, right? Because you know to calculate the cost of ordinary shares, right? So we can use this dividend discount model, and using that, it is possible to calculate the cost of existing ordinary shares or the cost of new ordinary shares, right? So if you are going to calculate the cost of new ordinary shares, you know the issuing cost, the flotation cost should be adjusted. Cost of preference shares can be calculated easily, because there are, you know, one point you should know for this corporate finance part, and not only corporate finance, for this all finance modules, financial mathematics concepts you should have a clear understanding. Because here also, when there are some details relating to certain projects, which you can use some financial mathematics concepts, you can do the analysis so easily. Right now, for example, this way, project, right, like this. Project A, this is the nature of the cash flow. 1.75 million each year from year 1 indefinitely. Right? What do you call this pattern? What is this cash flow pattern? What do you call it? Okay, annuity, but special annuity. Perpetuity. That's the term. That's the correct, right? That's the correct term. Perpetuity. Because this is annuity, but special annuity, perpetuity. And so to calculate the NPV of this project, you need only 2-3 seconds, right? You need only 2 seconds to calculate the NPV of this project, right? Because how do you calculate the present value of a perpetuity? How do you calculate the present value of perpetuity? Exactly, right? It is the cash flow divided by discount rate. Cash flow divided by discount rate, right? The easiest formula, maybe easiest formula in finance, present value of perpetuity. So when you know that, you need, right, very simple point. And sometimes when certain fixed cash flows are given for certain number of period, we can use annuity factor. But if it start from certain, not from the beginning, but here also for the first year, one amount, from second year to 7th year, another amount. So, right? So then that means there are 6 cash flows, 6 fixed cash flows, which means annuity for 6 years. So what is the annuity factor? If you are going to use annuity factor, what is the annuity factor you should use? Annuity factor for 6 periods at the given discount rate, right? For certain discount rate will be given, right? For that discount rate from year 2 to 6 or 2 to 7. From year 2 to, right? We have to get at that particular discount rate, what is the annuity factor for year 7, and we have to deduct the discount factor for the first year, because this is from 2 to 7, so we need 2 to 7. That means 1 is not relevant. 1 is not relevant. So we have to get the annuity factor for that particular rate for 7 years, and from that we need to deduct the discount factor for the first year. Right? Is that clear? Because we need, as you one of you correctly mentioned, 2 to 7. 2 to 7 means we get for 7 years, and we deduct the discount factor for the first year. Right? Discount factor for the first year. So that's what we do. Right? So these are, these calculations you can do easily. So therefore, so these financial mathematics concepts important. Right? Financial mathematics concepts. Here I didn't try to discuss these financial mathematics concepts. Right? So here, which is not possible to revise the entire finance syllabus in 4 hours. Right? So here, so you know about this simple interest, compound interest, and effective interest, average compound rate of return, and real interest. So this is what we discussed earlier as Fisher formula, right? And continuous interest and annuities. And when you use annuities, you know how to calculate this present value of ordinary annuity, annuity due, right? So these concepts, I'm sure you all familiar, right? So how to calculate the present value and future value of annuity, right? So, and then deferred annuity, perpetuity, right? So here, so these are important financial mathematics concepts, right? So you have to use to analyze these problems, right? So using that, so when you calculate, right, if you have to calculate the weighted average cost of capital, so we need to identify the cost of each source of capital and identify the weights for each source of capital, and using that, the weighted average cost of capital can be calculated, which should be used, right? Which should be used as the discount rate, right? Should be used as a discount rate, right? And so using that, you can easily analyze the project, right? You can easily analyze the project, you can rank the projects, and you can give the recommendation, right? And so when we are going to do this, and so one of you asked earlier also about these foreign investments. So foreign exchange rates, so that is a significant risk, right? So you know that especially when there are projects that involve investment in other countries, which will expose to the exposed to a foreign exchange risk. Okay, so here there's a request to explain the valuation of equity and firm, right? So equity valuation, right, because that is required, that is important to value a business, right? The valuation of equity, which is that means when we are valuing financial assets, right? So when we value financial assets, that is one more difficult part we need to do, right? Because when you are going to value any financial asset, so the principle is we have to calculate the present value of the future benefits, right? So therefore, whether it is equity or debt, the principle is same. But even though the principle is same, so when you are going to calculate the price of equity and debt, the level of complexity we have to face will be same, or the valuation of one category is more difficult. What do you think? Valuation of one category is more difficult, or valuation of both equity and debt involve the same level of complexity. Which one is easier, or which one is more difficult? Equity difficult, right? Equity difficult. Why? Debt easy, right? The valuation of debt instruments so easy, right? But valuation of equity is difficult. Why? Because even though the principle is same, right? To calculate the price of a debt instrument easy. Why? We know the future benefits in advance with high certainty. And that's why debt instruments are known as fixed income securities. Fixed income securities. Principle is same. We have to calculate the present value of the future benefits, but we know the future benefits with high certainty. And that's why the debt instruments are known as fixed income securities. But the valuation of but even the principle is same. So one of you have mentioned present value of future cash flows. That is even for equity. That is the principle. That is the principle. To calculate the value of equity also. That is the principle. Present value of future cash flows. But why it is difficult? Equal valuation, why it is difficult? Future cash flows. Do we know? Do we know the future cash flows? No, it is entirely it depends on estimates. But debt valuation, right? It's entirely based on assumptions. Equity valuation entirely based on assumptions, estimates. But debt valuation, is it necessary to make assumptions for us? We need only, now for example, to calculate the price of a bond. If you are going to calculate the price of a bond, we know the term to maturity, we know the face value, we know the coupon rate. Only thing we need is required rate of return. That's also relatively easy. But if we are going to do the equity valuation, right? If we are going to do the equity valuation, it is entirely based on what? It's entirely based on estimates. And that's why it is difficult. That's why it's difficult. The equity valuation, right? So this free cash flow method and free cash flow to the firm and free cash flow to the equity. Because okay, so one of you have mentioned why equity valuation is difficult. There are many bases, right? Okay, that's actually the reason. The most commonly used method for the equity valuation is called dividend discount. But that cannot be done for all the companies, no? Because all the companies may not have regular dividend. And that's why, so as some of you have mentioned here, we have to use cash flows, right? So free cash flows to the firm, free cash flows to the equity, or the comparable models, right, to do the equity valuation. So therefore, one point, it is reasonable when you say there are many bases. Reasonable, right? So, but the more difficult part is in addition to the more bases. So whatever the base we used, it is based on what? Estimates. Equity valuation entirely based on estimates. So that's why we need to make a lot of assumptions relating to the expected dividends, expected selling price. But when we are going to, now for example, if you are going to calculate the price of a 30-year bond, we know what is the coupon payment we are going to get in 30 years. But if we are going to buy share as a long-term investment, right? But say 10-15 years we are planning to hold. So can we estimate the dividend for 10 years or 15 years? That is not realistic, right? So normally we never do estimate for a long period like that. No, that's not possible. That's not realistic, right? So therefore, when we are going to do the equity valuation, rather than estimating these dividends and the selling price for the period, we are planning to hold the share. And the other thing, equity valuation is important not only for the investors, equity valuation is important for the companies. And when one company is planning to acquire another company, they do equity valuation. So then, this 1 period, 2 period model is not relevant. Shareholders may change, but company has to pay dividend continuously, right? So this 1 period, 2 period model is not relevant. And that's why in equity valuation, one main assumption relating to what? Dividend growth rate. Dividend growth rate. And so dividend growth rate also, there are different models. Zero growth model, constant growth model, non-constant growth model. So that's why the equity valuation considered to be more difficult, challenging. Even if a same bond is valued by different, right? So here we have about nearly 300. So if we calculate the price of a bond, right? So we all will get very close answer for a particular bond, right? Because market interest rate also, there cannot be so many different rates, right? We know there is no one market interest rate for a particular maturity accepted by everyone. But there cannot be a significant difference in different sources. Right now, for example, 5-year interest rate, there are going to be huge differences. Right? You know the reason. I don't need to explain the economic concepts relating to that. So answers will be fairly equal. But if the same equity is valued by different investors, different analysts, what will be the answer? It will be completely different, right? Because we do estimates based on what? Based on the information we have. That's why I mentioned earlier, especially for these stock markets, many people, even with financial literacy, not willing to invest, right? Why? Why? Markets are not efficient. Information not readily available. Lot of manipulation, right? Lot of manipulations, right? Some people, those who can influence the market, they create artificial market conditions, artificial demand to increase the price sometimes, or artificial supply to decrease the price, right? So that many people start to sell and they acquire. So many manipulations. And that's why equity valuation is difficult, right? That's why equity valuation is difficult. So even even a person with very good financial literacy, with very good understanding about valuation models, may not be able to calculate the fair value of a share if unless the proper information not available, right? So therefore, this analysis entirely based on estimates. So equity valuation, actually these different models, if we try to discuss, that will take a long time. But mainly the most commonly used models to do the equity valuation, right? So we do the share value with the constant growth in dividends. But even if we use this share value with the non-constant growth, we have to use the constant growth model at one point, right? But here, so this the valuation concepts, I'm sure you have learned this, but we will not be able to discuss in detail. So the important thing, using these valuation models, right? Whether it is equity or debt, right? These using the valuation models, what is the price we estimate? What is the price we estimate using the valuation models? Right? Why these valuation models are important? Because, right, so one can say, okay, so one has mentioned market price. Is that correct? Right? So there is correct answer. We are not going to estimate the market price. We are going to estimate the intrinsic value. That is the correct term. So, right, as number of answers there, right? Using the valuation models, we don't calculate market value. Can we calculate market value using valuation models? No. Term has the meaning market. Market value means what? Market decide that. Right? Can we do that using valuation models? No. Market price means that is the price determined by market forces. Even in some finance books, I have seen calculate the market value. So they have given a question and write the the detail, and the question is calculate the market value. That's wrong, right? You can't calculate market value. So that's why many of you have mentioned the correct term here, intrinsic value. Using the value, using the valuation models, we calculate. Okay, intrinsic value. So another description is given here: minimum guaranteed value. Is that the meaning? Intrinsic value. Actually, okay. So it's good if when we use some method to explain like that, because intrinsic value too technical, right? And so not very common, simple term. What is the meaning of intrinsic value in simple terms? What is the meaning of intrinsic value? Expected. It is not actually the expected. Right? Underlying worth. Okay. I will tell in simple terms. Right? Okay, this underlying worth, it may be value for one person, it may differ. Okay, that's true. Right? So that's correct. But I mean, what is the meaning of, okay, so you can say like this way also, the actual worth of an asset, underlying worth, right? So the simple meaning, right? And as you correctly mentioned, one of you mentioned value for one person differ from another, right? That also indicate the correct meaning of this. Intrinsic value means what? The actual value, right? That means that is the maximum value a particular person is willing to pay. So therefore, for that person, that is the value. The person consider this asset worth this much. The actual worth. That's why your description is correct. Right? Your description is correct. So for the intrinsic value means the maximum value. Right now, intrinsic value for me means what? The maximum value I am willing to pay. So that is the, I consider that asset worth that much. That's what some of you have mentioned. Nice term, underlying worth. Right? So we in finance we use the term intrinsic value, fair value. Fair value. It is the fair value, right? So using valuation models, we estimate fair value. Why it is necessary to estimate the fair value? When the market price is available. So if you are going to buy or sell a particular asset, we need to do the trading at which price? Market price. Then if you have to do the trading at market price, what is the reason? What is the purpose of calculating intrinsic value? That is to identify whether the market price is fair. And based on that, we can take the investment decision. Whether we should buy, we should sell. We can identify whether that particular asset is fairly valued, undervalued, overvalued. That is the purpose, right? That is the purpose. So using these valuation models, we estimate the intrinsic value. Once we estimate the intrinsic value should be compared with the market value. Right? So the intrinsic value should be compared with the market value, and then it is possible to see whether the market price is fair. Right? So fair value, which is intrinsic value, should be compared with the market value. It is possible to identify that whether that asset is fairly valued, undervalued, or overvalued. That's the purpose. And then you can decide whether you should buy it or whether you should sell it. And for the organization also, it is important. So they have to identify the fair value. The market has decided one particular price, but when they are going to issue new shares, so they have to see what is the fair value. The market price is there. When one company is planning to acquire another company, they need to identify the proper value, right? Underlying worth, right? What is the actual value, fair value of this asset? And that's why this valuation model is important. So equity valuation should be done with detailed evaluation, which require a lot of effort, a lot of information. So that's why to estimate the price of a share, two main techniques are used, right? So you have learned, I'm sure you have learned, there are two main analyses to estimate the price of a share. What are the two main analyses? We can estimate, okay, fundamental analysis and technical analysis. That's correct, right? So fundamental, so one of you have mentioned that the different approaches to estimate the share prices, right? But what I ask now to estimate the price of a particular asset. There are two analyses. So that's what, so you have mentioned here correctly, fundamental analysis and technical analysis. So, these examples are used here, right? So here, these are relating to which analysis? These are fundamental analysis. Using some fundamentals, cash flows, dividends, earnings, right? We estimate the price using the information, historical information, publicly available current information. We estimate the price. And that is fundamental analysis, right? What is the meaning of technical analysis? What is the meaning of technical analysis? Technical analysis means based on trends, charts, right? Based on charts, exactly. Here, so one of you have mentioned the exact charts. That's why those who use technical analysis, in some books you may have seen, those who use technical analysis are known as chartists, right? So you have seen in finance websites, right? This technical analysis, right? So here, as I mentioned, there's an issue with my laptop. So technical analysis. So there is a trend, right? So we identify the trend, right? And that even can be related to this market efficiency, right? Okay, so using this technical analysis, we identify the trend, right? And based on the trend, we estimate the price. And that is the meaning of technical analysis. And that's why, it is purely based on charts, based on trends, right? So those who use technical analysis, those who support technical analysis, they consider trend is your friend. Trend is your friend, right? But those who criticize technical analysis, they add one more point. What is that? Trend is your friend until it bend, right? Because we never know when will the trend change, right? So therefore, based on this trend, so one can say, okay, so this is the point we have to buy, right? So when the prices are increasing, but we don't know whether currently, this, since it is purely based on charts, historical information. So if we are currently here, buying will be the best option, right? But if we are currently here, when the prices are increasing, right? If we buy, what will happen? So it will decrease. So that's why trend will tell you, will give you some, this technical analysis. That's a big subject. So in our MSc, we had one complete module, trading techniques, right? But it's a big subject, right? So so there are number of concepts that we have to use to identify the different factors, right? So using this, the equity valuation, right? So the business valuation should be done based on that assumptions, right? So which require some considerable time to discuss in detail, because different models are there, as you mentioned already, different bases, different approaches to estimate the share price, right? And we can now discuss some key points related to derivatives, because that's also included in this material, that syllabus area, right? So very briefly, we'll discuss about these derivatives, that part also. You learn derivatives in your exams, right? Derivatives, right? Okay, so here derivatives very quickly. So during the remaining time, okay, so it was there, right? So that means these derivatives, so fairly, in our financial markets, we get less opportunity to get the experience related to derivatives, because there is no active derivatives market in our country. Only Yeah, actually, in banks also, all these derivative instruments are not used, right? So because only few derivative instruments are used in our country. Uh, so the main points, right? The main points we need to know the basic concepts. Derivatives, whatever the type of the derivative instrument, the main features. These are the contracts, agreements between two parties to do the transaction at some future date at a price agreed today, right? So therefore, these are agreements, contracts between two parties. One party agreeing to buy, one party agreeing to sell, right? And both then the transaction take place at some agreed future date, the price agreed today. Why it is necessary to enter into agreement today if you need to do the transaction at future date? What are the objectives, right? The main objective is called hedging, right? The mitigation of risk. Even though derivatives have been developed to eliminate risk, many parties use derivatives to take risk. Because here, for any derivative instrument, there is underlying asset, right? There is an underlying asset for any derivative instrument. For any derivative contract, there is an underlying asset. Okay, that means one party agreed to buy a particular underlying asset, one party agreed to sell that asset at a future date, agreed date at an agreed price. Both parties, right? Okay, not for all the types, right? So they have, they agree to do the transaction. So when you have the experience, knowledge about the movement of price of a particular underlying asset, so what you can do, you can use that knowledge, you can use that experience to enter into a contract to make profit. That is called speculation. That is called speculation. So even though derivatives mainly develop for hedging, that is to eliminate risk, to reduce risk, many parties use derivatives to take risk with the expectation of making profit. So you know the difference between speculation and arbitrage. What is the difference between speculation and arbitrage? You know the concept arbitrage, right? Okay, arbitrage, the meaning is that means speculation not necessarily short term. Okay, this is the essential requirement to consider as arbitrage, right? So one of you has clearly mentioned to make arbitrage profit, it is essential to identify mispriced security. Mispriced security, right? So that's why here, so one of you correctly mentioned, it is getting the benefit in price difference in different markets, right? So that means, okay, one person has mentioned covered risk. That's also, valid. The reason arbitrage means riskless profit, right? Arbitrage means riskless profit, which can be made only if you identify mispriced security. And that's what so one of you mentioned here. If you identify the same product is traded at different prices in two different markets, so you can get the benefit from that price difference to make arbitrage profit, which means riskless profit. So generally, to explain this arbitrage profit, it says it is the riskless profit that can be made without investing your own money. So arbitrage usually involves leverage, so borrowing and investment, right? So the main difference between speculation and arbitrage is that speculation involves risk, but arbitrage means riskless profit, right? Speculation means expecting this will happen, we enter into a transaction, right? So we might make profit, we may have a loss, we may incur loss, but arbitrage means riskless profit, which we can make only if we identify mispriced security, right? That means if we identify the same product is sold in two different markets at different prices, right? So therefore, for any derivative instrument, there will be two parties, long and short, right? So known as long position and short position, which so you know these things, and so four main derivative contracts, right? Four main derivative contracts: forward, futures, options, and swaps, right? Even though we don't have time to discuss in detail, you know the key features of this main derivative instrument and the main differences, right? To get the maximum benefit from this limited time, I have summarized. And so here, what are the key differences between forwards and futures, and what are the main features of options, and what are the main features of swaps? You know, forwards and futures, there are a number of similar features, right? Similar features. One party agreeing to buy, one party agreeing to sell, both parties have obligation. No, right? No, both parties have obligation. The transaction should be completed at the maturity date, right? But the differences are due to the organization of the contract. Forwards are non-standardized, futures are highly standardized. Forwards, no third party. Futures, there is a third party known as clearing house. Forward, there is no margin requirement. Futures, there is a margin requirement. Initial margin, maintenance margin. Forwards are not marked to market, but futures contracts are marked to market at the end of every trading day, right? So therefore, forward, the default risk is high. Futures, default risk is low. So those differences are there. The key difference between this and options, as the term implies, holder of the contract has the option. Holder of the contract has the option. There are two types of option contracts, call option and put option, right? So call option will give the holder the right to buy. Put option will give the holder the right to sell. So the other party has the obligation. So therefore, the key difference between options and other derivative instrument, all the other derivative instrument, one party is not making payment to the other party at the time of entering into the contract. But option, one party has the right, one party has the obligation. So the party getting the right need to make the payment to the party getting the obligation, right? That means the buyer of the contract has to make a payment to the seller of the contract, right? So that is the main difference, major differences between options and other derivative instruments. Swaps, the main difference, all the other derivative instruments, only one party making payment to the other party, but swaps, the two parties exchange, right? Payments. So two main types of swaps, interest rate swaps and currency swaps, right? And so these derivative instruments are mainly used to manage, these are the external factors that the companies can use to manage the foreign exchange risk, right? Because foreign exchange risk, which arise due to the change in the foreign currency, which you may have learned under different categories: transaction risk, translation risk, economic risk, right? So, this risk can be managed using internal hedging strategies like matching, leading and lagging, currency diversification, multilateral netting, right? Then pricing decisions. There are various internal hedging strategies, but in addition to that, there are external hedging strategies like derivatives, right? So mainly using these derivatives, it's possible to manage the foreign exchange risk. Not limited to the foreign exchange risk, can be used to manage the risk relating to many other things, but mainly to manage the foreign exchange risk, also hedging strategies can be used. So, the key points included under the corporate finance part, I revised. So here, using this session, within this session, and the materials will be shared with you, right? So I share with the institute so that you will get all the material. And so if you need any additional information, right? Okay, my email address is there, so you can ask, right? So I can help you to get more information, because corporate finance, that's a broad area, right? And so I'm quite happy that based on the answers you gave, I feel happy you have the proper understanding about these concepts, which is very good. So that's why I always like to conduct a lecture for our institute. So as a member of this institute, I'm quite happy, right? Right. So even though I do lectures for some other programs, right? Okay, so here, how do the banks work on AML CFT works, right? Okay, that's good. In fact, so if you asked that bit early, I could have explained in more detail because, as I mentioned, I'm attached to the financial intelligence unit of the central bank, which I directly deal with the intelligence management, the AML CFT requirement. So I'm in charge of the intelligence management division and financial data management division, especially for the banks, right? So okay, for banks especially, they have to uh, uh, comply with this AMA CFT requirements as recommended by this Financial Action Task Force, right? So in order to comply with this uh, anti-money laundering and countering of financing of terrorism, right? AMA CFT requirements. In fact, there will be a session at the Chartered Institute which I plan to conduct in December, but so due to that, 2 days after that particular disaster, so therefore it was postponed in January, right? So the first part I'm going to do that in that session. But anyway, for the moment, the banks and even the other institutions, right? So they need to have a clear understanding about this the sources, right? Sources of funds of their customers. So they have to continuously analyze this KYC and CDD rules, right? Customer, know your customer and customer due diligence rules, right? And so they need to make sure these funds came from the legitimate sources. And whenever there is a requirement to report all the transaction above certain level threshold transaction. But in addition to that, STR, suspicious transaction without any limit, suspicious transaction should be reported. STR and SAR, suspicious activity reports, right, should be provided by the banks and other organizations to the Financial Intelligence Unit. And without disclosing the name, that is the support to the economy, the country, to combat, right? So to prevent this money laundering and terrorism financing for the benefit of the entire country. So the banks and other organizations, they have the responsibility, they have the duty to do that, right? So it is necessary to comply, perform these functions to comply with AML safety requirements, right? It is much better if we had a physical session, right? So because earlier, sometimes back, so for this case study, we delivered a lecture at the Institute auditorium, which is fairly good. I can see you, which is more interactive, right? But especially when even this online session is conducted for for this, I call chartered accountants, right? So this I don't feel any. I mean, it's not difficult. This is not boring. So you continuously engage, you interact. So that's why I like our institute. I hope you all will do this. And if you need any additional information, you contact. I will send the additional information relating to this. Okay, so continuously, other than that short break, so we continuously, did this, and so thank you so much for the active participation, right? So I wish you all the best for the final hurdle of this great program. So I hope to, I haven't seen any of you, but you have seen me. So when you see me in the next national conference, so say hi, right? So like to see you, right? So okay, thank you so much. I wish you all the best in everything you do.